Hello. Well, welcome everyone. We're so excited that you're here. My name is Sadia Sheikh. I'm SIOR Global President-elect. Based here in New York City. But first, I'd like to recognize SIOR New York City, first of all, for their leadership in hosting this event and bringing everyone together, but then also for live streaming this globally. So we've got SIOR's industry partners from all across the globe tuning in today, and it's also recorded. So first chapter to lead that. And then also just a little bit about SIOR Global. Again, we're all about bringing the best of everyone together in the industry, from firms geographically, including everyone in this room today. So we've got a great program ahead, and in SIOR spirit, enjoy networking, connecting, and building relationships with everyone in the room, but not just the people that you know, but the people you have yet to meet. Thank you. And I would like to introduce Mario Asaro, who's the New York chapter president.
Just to correct, it's downstate New York. There's a whole thing for that, but but we like New York chapter president. Thank you, Sadia. As she said, I'm the New York chapter president. I own Industry and Realty. I'd like to take a moment to introduce my executive team. Of course, you know John. I'm going to introduce in a second. John Stravitz of Greenwood CRE. We have Ken Saltzman, who is the treasurer, and he is with Lee and Associates. And I don't know where Devon left us, probably had to go to the bathroom. Devon Peters with Avis and Young. He is our secretary.
And let us in beautifully.
But he's the most handsome man, you can't miss him when you see him. So that being said, I'm gonna end it here and keep it short because John has a great, he always puts together a great event, and I'm gonna leave it to him to get started with that. So John, would you take the helm, please?
Intimidating? No, not this crowd. I'll give you pressure and intimidation. A diaper. Oh yes, a diaper. At an ungodly hour in the middle of the night, with your wife next to you that recently gave birth, and still staring at you wondering, how could there be children on earth if men had to give birth? Her look only states one thing: change that diaper. Change it fast, and it better be good. Because if not, you're cleaning up this mess. Now that's intimidating. Did I mention she's Russian? And how many times do I have to tell everyone I'm not the kid's grandfather? And yes, the kid is already laughing at me for having more hair. If you haven't figured it out, 3 weeks ago, we had a little man. And I might not make it to the 4th week or through this event. But today we conference, and we conference well. We will discuss pertinent topics like the economy, office to residential conversion. Our mayor stated 100,000 new homes have to be created by 2030, and success with Bob Knackel. My name is John Stravitz. I'm VP of New York City and downstate, and recently honored to be appointed your Northeast Regional Director. I have over 25 years of commercial real estate experience with a legal background. John Ayers is my partner, and we run the New York office for Greenwood Commercial Real Estate, a minority-led commercial real estate organization focused on optimizing the corporation's real estate. Our specialty is office, industrial, and medical. This is a story from the past. The year was 1930. The event was a German Physical Society conference held in Leipzig. After the president of the association profoundly praised Einstein for his great speech, to the thunderous applause, he asked if anyone in the audience had any questions. For a little while, silence seared across the hall. Who would dare to question Einstein, one of the world's most respected physicists? A juvenile-like voice erupted from the last row of the room, and in a broken German language, spitting words that held the audience spellbound. What Professor Einstein said is not stupid, but the second equation he wrote does not follow the first. In fact, it requires further assumptions that have not been made, and what is worse, it does not satisfy a criterion of variance, as it should instead be. He echoed fearlessly. All heads turned reflexively towards this bold, defiant voice that submerged everyone in disbelief, unable to contain their irrepressive astonishment in the engulfing noiselessness. As they struggled to breathe under his bizarre sea of bafflement, wondering who that might be, Einstein was deeply lost in scrutinizing. He said erroneous equation on the blackboard, almost transfixed by this new revelation, except for his hand, which was mechanically scratching his mustache. After what happened to be 60 seconds or so, Einstein turned around, admitting his mistake, and then said, "The observation of that young man over there is perfectly correct. I therefore ask you to forget everything I have said to you today." I'm not going to do that, by the way. We're not going to forget everything up here. On that day, at that precise moment, destiny plucked the fearless young man of 22 years from obscurity and made him the leading theoretical physicist of the Soviet Union, arguably one of the greatest geniuses of all time to ever illuminate the rocky planet of Earth. That was Lev Davidovich Landau, for you ladies and gentlemen. Similarly, on that day, Albert Einstein demonstrated the kind of unadulterated humility that genuine knowledge bestows on any vessel of flesh that houses it. True education humbles, not the other way around. Be humble. The ABCs of Science by Giuseppe Massardo, 2020 Springer. So the message here, and I always like a message from the past to relay to the future, is humility. It's just critical to what we do, and we need to be humble in everything we do. Video, I'm not sure who I do it?
You do. I'll do it.
Please.
SIOR is the Society of Industrial and Office Realtors, the top gun of commercial real estate. This is our Northeast Regional Conference. You want to meet people that can help each other, learn from each other, and best practices. It's about being a giver. We're in a service industry, commercial real estate world. I work for owners, I work for tenants. We give, and that's the key. And if you get it, you're gonna have lifelong relationships.
Thank God they used the correct video. Yeah, no one wanted to see baby videos. I'm sorry, that would have been inappropriate. This conference embodies SIOR and what makes us top guns. Why become an SIOR? Membership, networking. A perfect example is one of our webinars, Sherry Best, who's part of Crew, who's not here today, and Andrea Corney from JS Held, who's one of our sponsors and been very active. Andrea gave a webinar on carbon credits for us. And from that, they forged a relationship and have now done business. That's the key to all this. I mean, we're here to learn best practices and networking. So yeah, we're just grateful for everyone to be here today. And then our sponsors. Seriously, where would we be without our sponsors? Certainly not enjoying these views or this venue. Most importantly, business opportunities. That's why I wanted this live streamed. I want business opportunities for everybody, especially the sponsors, to be seen and known everywhere. And that'll add to everything we're doing. The sponsors for this event, we have 6 sponsors. Hunton Andrews Kurth, the law firm, Robert Brusco, partner, and Brett L. Gross, co-chair of the Global Real Estate Practice. Number 2, JS Held, Mike Novak, Environmental Services, and his relationship with Rob is the reason we are enjoying this venue. Bank of America, Mario DeCervo. Mario and I, exactly what I was saying about the networking, sponsors, and becoming friends. I do consider Mario a friend. He's been amazing to everything we try to achieve with this chapter and one of our greatest supporters. Moody's, new friends, Matthew Shiver, Joe McBride. Matthew will be up here in a minute. CoStar LoopNet, Kristen Nave and Jim Ziegler, our local reps. They've been fantastic to this chapter. And Axis Insurance, Paul Hacker, and Mike Smith. Just wanted to thank everybody for assisting us in everything we do. Speaker one, Moody's, Matthew Shriver. Matthew?
Oh, did I send you slides? Perfect, good.
No slides.
Hey, everybody. My name is Matthew Shiver. I'm the Director of Business Development and Strategy for Moody's CRE's products. My message is going to be very short, and it's just one of saying thank you. Thank you, John. Thank you, Ken. SIOR has been a critical partner and friend to Moody's over the last few years. We're incredibly excited of expanding this opportunity through this year, and not just the local level, but also the national level. A quick announcement, as some of you in this room may know, Moody's has launched a free-to-list commercial real estate marketplace that is now live. SIOR was kind of critical in those early days of that launch, bringing awareness out to the brokerage community. And I really just want to say, Moody's is specifically focused on recognizing the fact that brokers are the core and the lifeline of the commercial real estate industry. Without you, this industry, struggles and needs to move on. And the fact that you guys are here are able to just relay the fact that Moody's is very committed to you and your needs, but we also put a challenge out to you. We need to understand what your needs are. So communicating with us, asking us questions, giving us feedback, allowing us to kind of listen and understand your needs is going to allow us to build better and better, bigger and better products moving forward together. So without further ado, I'm going to pass it off. So thank you all so much. And please feel free to meet with me and my team. We've got Josh, Chad, Kevin here. Ask us any questions. We'd be happy to talk to you about some of the exciting products that we're going to be bringing to market for you this year. So thank you so much.
Great. Also, one day SIOR might get rated. So if we want to be rated, we want Moody's on our side. Bank of America, Mario DeServo, please.
Good afternoon. Again, my name is Mario DeServo. I am the Northeast Region Executive for Bank of America, and I'm in charge of commercial loan origination. And our team specializes in working with commercial real estate brokers, like many of you in this room. One of our key focuses is financing owner-occupied commercial real estate, which is a vital piece of the commercial real estate landscape. And we are proud to lead in the way in SBA 504 financing, offering up to 90% financing for eligible borrowers. And the real advantage for brokers is that we have an industry best 58-day turn on average for SBA closes, which means you and your clients get to the finish line and get paid faster when we're involved. In addition to our expertise in SBA financing, we also have a dedicated team of specialists who focus on the healthcare sector. We focus on practices on doing build outs and providing up to 100% financing for eligible healthcare borrowers, helping them invest in their future with confidence. And beyond financing, our commitment to you extends to providing advice and insights to help you guys succeed. We're incredibly fortunate today to have our talented economist, Shruti Mitra, here as part of our team. And Shruti has a wealth of knowledge to share, and I know she's going to provide valuable insights on the trend shaping the real estate and broader economic landscape. And clearly, lots of changes, especially over the last several weeks. And as proud sponsors of SIOR, we understand the value of the relationships built in rooms like this. And I would strongly encourage you to connect with our team after the event at 5 o'clock for cocktails. Everyone will be wearing a Bank of America name tag. And I just thank you for having us. The networking piece, and it's what it's all about. So thank you and have a great day.
What you don't know about Mario is he's a long-suffering Met fan, but he and I are having a little bit of a difference right now because they got Soto. So we're a little upset about that, but he's very happy right now. And our third speaker, as the sponsors go, of course, Hunton Andrews Kurth, Robert Brusco, partner. I'm going to give a little bit of background on Robert. Robert Brusco is known across the real estate industry for his outstanding deal structuring skills and practical business perspective. Clients want him on their side, not only for his strategic savvy, but his strong industry relationships, which are the product of over 25 years of immersion in commercial real estate. Rob has a robust comprehensive practice that represents major investment banks, Bank of America, if they're not on that list, let's talk, lending institutions, private equity funds, developers, investors, and operators in all types of commercial real estate matters, such as acquisition, disposition, financing, joint venture, and leasing transactions. A seasoned practitioner, he has negotiated, structured, and closed several $billion worth of large-scale, complex real estate debt and equity transactions. His broad experience also includes loan participation, sales, and syndications, as well as real estate asset restructurings, workouts, and recovery. Even more interesting is when I was introduced to Robert by our mutual friend, Mike Novak, I actually, for some reason, just looked it up in my phone and had his name. We met decades ago when he was at Lehman. So I just find it amazing how small our world is when you've been in the industry long enough. Robert, stage is yours.
Wow. I mean, I'm not, you took everything I was going to say, John. So I'll be brief. Listen, thank you very much. I just wanted to welcome everyone. I think, we are ecstatic that we were provided the opportunity to give you a venue to come and enjoy, this year's SIOR New York City Winter Conference. For us, it's always a great pleasure when we can have, industry folks like yourselves come in here and really, for me personally, and I think also for our client base, which by the way, we're live streaming this to many of our clients. I think it's important for them to have access to kind of market intel. I think you all have your finger on the pulse of what's going on in the marketplace. And I think that's always a tremendous asset for our clients. I think it's a tremendous asset for our lawyers here. So I just want to thank you all for giving us the opportunity to host you all here. I actually wanted to make this pitch while I was serving drinks at the cocktail hour, but John said I had to do it now. Look, I think we're a full-scale law firm. We have a real estate group of about 80 lawyers. We have presence in almost every major market across the country. We did about 70 billion in transactions this year. I think we basically pride ourselves. Look, I pride myself and also our team on really bringing a practical business sense to all transactions. At the end of the day, no one's happy if the deal doesn't get done. So not only are we really good problem identifiers and risk assessors, but we're also we look to find solutions in order to get the deal done. So if there's anything we can help you with, just let us know. I think John and Ken and team have put together a fantastic program for you today. So enjoy the program, enjoy our space, and again, thanks for coming.
If anyone knows how we like to do these conferences, we like to do them organically. So I give out my cell phone and then you can text and blow up my phone. But while I have the speakers up here, if anyone has questions or anyone live streaming anywhere has a question and wants to ask our speakers, they text me. So we did that last year for the first time. We thought it was a great innovation and it worked so well. So 201-232-2767. Please text me with any questions. If we don't get to them during the conference, we'll retain them and try and get to them afterwards with the speakers. Also, if someone from one of the conference rooms on the floor here wants to ask a question, please just walk into this room. We're going to have a mic for you and you can walk in and ask that question. But this is a new format. We've never done it before. So just so everyone knows that this large room fits around 60, 70 people or so. And then we have another 60, 70 people or so in the conference rooms. So basically everyone can enjoy the conference, but it's a different format. And if anyone has to do any business or take any calls or anything whatsoever, they can go out into the conference rooms or the conference area while the conference is going on. So we just thought that was a really great feature. And that brings us to our session, our first session. So I don't know if we're going to start that at 2 o'clock. So we've got 15 minutes to drink, network, talk, and take a break. All righty, session 1, the economy. We have Shruti Mishra, a U.S. economist from Bank of America. Shruti is a US and global economist at Bank of America. She focuses on the GDP outlook for the team using both quantitative models as well as the GDP tracker. In addition to that, she also looks at the US consumer and contributes to the widely read Bank of America on USA Card Data Report, as well as other thematic research on labor markets and the real economy. Shruti has a PhD in economics from Columbia University with a specialization in macroeconomics and finance. Her dissertation focused on the heterogeneous effects of monetary policy, for which she won the Best Pre-Dissertation Research Award. She has also interned at the IMF, where she worked on post-COVID inflation and monetary policy dynamics in advanced economics, amongst other topics. She is based in New York. We also have Thomas LaSalvia, PhD and Director of Economic Research at Moody's Analytics. Thomas specializes in commercial real estate across property types, while his expertise encompasses space and capital market performance. Thomas's keen interest lies within the subdiscipline of optimal location theory. Dr. LaSalvia regularly represents his research to a variety of clients and organizations, with his insights frequently featured in leading industry and national publications, including the Wall Street Journal, the New York Times, Newsweek, Scotsman's Guide, and Commercial Observer. Prior to joining Moody's Analytics, Dr. LaSalvia was an industry consultant and served as lecturer of economics at the College of William and Mary. So our format today is going to be about 10 minutes each. Shruti's going to talk about a macroeconomic perspective, and then Thomas is going to give about 10 minutes also on a commercial real estate perspective. And then after that, we're going to ask a few questions, and then we're going to open it up to the room to ask questions. So, Shruti? Just push that to work, so.
Got it.
Good afternoon, everyone. Thank you so much for having me here. I was here last year as well, and it was, I think, one of the most interesting things that I did last year. I'm so happy to be back again. There's so much that has happened between this year, the last year, and this one. Before we, go into the one question, which I'm sure everyone wants to ask from a macroeconomic perspective, what does the election means for the macroeconomy? I think it's important to take a step back and look at where we were going into the election. So going into the election, if we were speaking back then, I would have told you that the US economy was in a pretty stable growth path. We were forecasting, above trend growth of about 2.3% for 2025, 2.1% for 2026. When I say that the US economy was outperforming in terms of growth, there were two big reasons behind our thinking. One was a more cyclical factor, which is the fact that the labor market had been decently stable, and I'll get into the volatility and the dynamics of that as I talk further. But broadly speaking, the labor market had remained stable, and the US consumer, the miraculous US consumer that does not stop spending. So that chicken and egg relationship that exists between a stable labor market, a US consumer that continues to spend, that was one cyclical factor that was keeping the US economy growing strong. The other aspect of why we were bullish on the strength of the US economy was a more structural and a more underlying reason. The fact that US productivity, underlying productivity, had been accelerating. Pre-COVID, broadly, there was this thinking that the average productivity in the period from post-financial crisis leading up to COVID was about 1.8%. And the broad idea was that the US is in this slow, sort of sluggish growth and productivity environment. Keeping the COVID shocks aside, we have seen productivity accelerate above the COVID trend in the last few quarters, which has made us more bullish on a more permanent structural underlying increase in productivity. One big sort of factor that, gives some credence to this argument is that business formation in the economy has consistently now been above pre-COVID levels. Investment in the economy in terms of, CapEx having these constant tailwinds to its cycles, right? Post-COVID, you had this big investment in the software side of CapEx. That sort of got passed on to the structure side of investment with the CHIPS Act, the IRA, which sort of crowded in private investment in the sector. As soon as that started slowing down, you had this handoff to equipment, where I'm sure we're going to talk about DeepSeek as we, go ahead, given that it just happened yesterday. But there has been this constant tailwind to the investment side of the economy. As much as, your labor market and the consumer has been strong, you've had these cycles in the investment side of the economy, which have kept that sector going strong. Broadly, when you put all of this together, you have a US economy going into the election on a pretty stable growth path. So that's broadly where we were going into the election. Now talking about, I think, the one big outlook change that everyone wants to hear from us when we, as economists, when we talk to a group of people want to know, what is the Fed going to do? I always struggle with, when to position this question, just because the moment I tell you what we think the Fed's going to do, you're not going to be as interested in anything else that I say after that. But, I'm going to be kind and I'm going to lead with that. Given the fact that the labor markets have been stable, yes, payroll growth has slowed down, as it should, if you want, an economy that soft lands or no lands, as we refer to it these days. The big factor that has kept the labor market growing strong or going stable is the fact that layoffs in the economy haven't increased. We've had a bunch of, payrolls report, which spark a lot of fears, recessionary fears sometimes. But underneath that, the one indicator that we look at when we want to point out the strength of the labor market is the fact that layoffs in the labor market have not increased. So with the labor markets being stable, which is on the positive side of things. Now coming on to the one aspect which I haven't touched, which is, the big factor right now, which is going to be decisive in what the Fed does, is inflation. Inflation on just mere fundamentals. And I'm not even talking policy or what does Trump's agenda do to inflation. I'm talking merely on the basis of fundamentals. Inflation has been running strong. We did get some relief in 2024, but if you look at the last couple of months, the core PCE measure, which is the measure that the Fed targets, that's consistently been running 50 bips above the Fed's intended target. Now, when growth in the economy is strong, labor markets are stable, and you have inflation, which is running above the target that you want, we don't see any reason for the Fed to cut any further. When the Fed cut in September, there was a very different reason for it. The Fed was a little bit more worried about, a deterioration in the labor market side of things. Since then, we've seen more stability on that side, but gotten a little bit worried about inflation. And I completely, I'm very cognizant of the fact that these two sectors have been flip-flopping for quite some time. But if you look at their last, sort of 6-month view, keeping aside the volatility, the labor market's broadly stable, inflation's the worry factor again. Given that, we don't think in our forecast horizon, which is 2025 and 2026, we don't think the Fed's going to cut any further. When I say the Fed's not going to cut any further, what I mean is the Fed's going to be on a pause or a hold, and I'm using both of those words being very cognizant of the difference between them. The reason is we do think there is a good probability that can be assigned in the Fed's next move. Obviously, when I say that the labor market's been stable, but payroll growth has, slowed down, the probability for the Fed's next move being a cut or a hike does come into picture. At this point, I would put the probability of a hike being much higher, just because you have inflation that's already running strong on the basis of fundamentals. And then comes the policy mix from the Trump 2.0 administration, which has a risk of increasing that inflation number. Given that, we do think as much as our baseline forecast is of a Fed that's on hold, we think the probability of the next move being a hike is much higher. Now, that's broadly where we are in terms of, if you don't look at the policy side of what's coming, that's broadly where we are, right? You have a stable labor market, stable growth, inflation that's running strong, a Fed which is thankfully has the luxury to wait and watch and see what the new administration does. Obviously, we are in the business of forecasting. So what we do when we think about, as much as there is a lot of, it's true, there's a lot of uncertainty about what the new administration will do. In the last 1 week, we've heard a bunch of different, headlines. What we try and do is to look at the macro impact of the Trump 2.0 administration. We try and I'm going to get to it, yes. So we try and filter everything down into 4 broad buckets. In terms of the macro impact, what's important for us is trade policy, fiscal policy, immigration, and deregulation policy. I mean, already in the first 1 week from the executive orders, the comments that you've heard from the administration, there's been a lot of flip-flopping on these fronts. What we try and do is we create a baseline assumption of what we think could happen, and then go from there in terms of analyzing the impact on growth, inflation, and what the Fed's going to do. So I'm just going to quickly walk you through what we think is our broad thinking on what might happen in the next 1 year in these main policy areas. So in terms of tariffs, yes, there is a lot of noise in terms of tariffs in Canada, tariffs in Colombia that just happened. We think of tariffs as something which is both a means and an end. Means in the sense that you want to use it as a negotiation tactic, as you saw in the case of Colombia. End is in the sense that you are going to have a fiscal policy that's going to be stimulative. By design, you want something offsetting that, right? You want the money for it being offset. So those are the 2 aspects of how we view our baseline assumption on tariffs. So broadly speaking, we think, keeping all the noise aside, there is going to be a doubling of tariffs on the ground in terms of an increase for China. Currently, China tariffs sit at about 20%. We see them going to 40% by the end of the year. Our second assumption is that the rest of the world will see an increase in tariffs, maybe as a second priority, but in terms of actions, we do expect that to happen. Rest of the world, ex of Mexico and Canada, in terms of average tariffs, sits at about 4% right now. We see that going up to 7 to 8% by the end of the year. The reason I'm very cognizant of the fact that I'm saying ex of Mexico and Canada, despite all the noise that we've heard in Canada. We think Canada falls more in, Mexico and Canada fall more in the means bucket, where tariff announcement will be used as more of a negotiation tactic. And given the fact that supply chains in this region are so integrated, we don't think you'll see on the ground action in terms of tariff implementation on Mexico and Canada. So broadly, a doubling of tariffs for China, rest of the world, ex of Mexico and Canada. In terms of fiscal policy, I think it's a no-brainer that the Tax Cuts and Jobs Act is going to get extended. But when you are raising tariffs, doubling tariffs for that matter, for a big part of the world, by design, you want your fiscal policy to be offsetting the impact of that. You want your fiscal policy to be stimulative. Merely extending the Tax Cuts and Jobs Act, which is the law of the land right now, that's going to be maintaining the status quo, right? So you want to do some other policies which will be stimulative. A couple of things which we think are going to be on the table. It's going to be reducing the corporate tax rate, the full expensing of CapEx. I know that sounds like a very boring thing, but that's something that really leads to business investment going up in the quarters when the policy sets in. So that's broadly what we're thinking in terms of fiscal policy, right? You extend the TCJA and you put some other things on the table in terms of having a package that's overall stimulative. In terms of immigration and deregulation, the last 2 buckets, those are harder to quantify, harder to really pin down what's going to happen in terms of policy implementation. But just to give you an idea of how we're thinking about these buckets, Immigration policy, we think, again, that's a policy area where there's a lot of noise. But broadly, we think that in terms of on the ground action, keeping the noise aside, you're going to see a tightening in the flow of immigrants. How quickly how quickly do the mass deportations play out in a very significant way is, I think, yet to be seen. So we'd put our money in terms of a very significant tightening in the flow of immigrants in the medium to long run. In terms of mass deportations, how much are you able to really move the needle on it from what's currently been happening? That's, I think, a little bit of an open question. In terms of deregulation policies, no doubt, I think if you look at the stock market movement post-election, this administration is a very pro-deregulation administration. You're going to see sweeping changes broadly in two sectors: financial deregulation, as well as domestic energy production seeing an increase. Again, I don't want to step into what aspects of financial deregulation will really play out. I think certain things like Basel III Endgame, that's off the table. But whether other things like Dodd-Frank Act, that's, I think, a little bit of an open question as well, right? So broadly, let's work with the assumption that you are going to see deregulation on these two fronts. How much, which policy areas, which regulations get impacted, we'll only know that as we hear more from the administration. So that's our broad-based baseline. Now, what does this do to growth and inflation? If you go back to where I started from, when we entered the election, we were on a pretty stable growth path. Now, what is this policy mix doing to growth? If you look at the first bucket of higher tariffs by design have a negative growth impact. So they will affect growth in the economy negatively. But the good thing is they immediately get offset by a stimulative fiscal policy. Similarly, tighter immigration has a negative impact on growth, but that in some ways gets offset by deregulation having a positive impact on growth. So what I want to say in conclusion is that this policy mix is broadly neutral in terms of its impact on growth in the economy. By design or by the way it's going to play out, it's going to have very offsetting impacts on growth. That's the reason we are still forecasting a pretty stable growth path. Even if everything that we've said ends up happening in practice, we still think the US economy can continue on a pretty stable growth path. So that's the good thing. Now coming to the not so good news on this front, as much as the policy mix that we're expecting from the Trump 2.0 administration is neutral on growth, we do think it's going to be modestly inflationary. If you look at the last row, higher tariffs have an impact in terms of increasing. You're already high on inflation on mere fundamentals. By the end of the second quarter, you'll start seeing the impact of higher tariffs on inflation. They'll increase inflation in the range of about 10 to 40 bips. As soon as that impact starts slowing down by the end of 2025, you'll have a stimulative fiscal policy increasing inflation as well. Tighter immigration policies on margin have the same impact on inflation. So broadly, everything in this policy mix, whether it's trade, fiscal, immigration policies, have an impact of increasing inflation. The only thing that gives you some relief is deregulation. If you do end up achieving higher domestic energy production, you could, help a little bit in the inflation story, but it's important to remember that you'll only be affecting headline inflation. The core measure of inflation, which X's out food and energy, which the Fed targets, that's still on net going to have a modestly inflationary impact from the policy mix. So given this entire story where you were on a stable growth path, you had inflation that was running strong, then comes in the new administration with its policy mix, which is broadly stable on growth, so some good news there. Modestly inflationary in its impact. It's yet to be seen how exactly will this play out. All of this means that for the Fed, it should stay ideally in a position of waiting and watching, seeing how the Trump policy agenda, especially higher tariffs, play out by the end of the second quarter of this year, and then make the decision. If the tariff shock ends up being extremely high, we would shift our forecast from being on hold to going towards a hike. At this point, we don't think there is a huge risk of that. But if inflation expectations in the market end up becoming unanchored, that's when our probability for a hike would go up further. So that's where I'll leave you from, a broad macro perspective. 3 points to remember. I know there's a lot of stuff: stable growth, not so stable inflation, hence a Fed which has the luxury to wait and watch given the uncertainty that you have from the upcoming policy agenda. Thank you. And we'll go into the questions as we talk further. Thank you.
Thank you, John. Much appreciate being here. From the Moody's family to the SIOR family, it's been really a fun ride over the last couple of years. Thank you for continuing to include myself and really a lot of my fellow economists and all of us wonderful people. So thank you. Shruti, amazing. Right, as a fantastic overview of the macroeconomic situation. What I want to do is I certainly want to go into some of those talking points. I think we will as the questions come in. But for the next 5 to 10 minutes, let me just give you a brief overview of the way we're looking at the commercial real estate industry in relation to a lot of what Shruti had just discussed. We'll start here with our outlook on interest rates and how it relates directly to our outlook on at least the composite CRE value index. What you'll see is what we've been saying for quite a while now. We are in a new interest rate and economic regime. So I'm not going to argue with Shruti in that respect. I think our levels of where interest rates are likely to land slightly different. Our probabilities of what the Fed may or may not do over the next 6 to 12 months may be slightly different. But again, generally speaking, we are also under the mindset that this is a higher forever type of interest rate regime. Structurally, we agree. Cyclically, we agree. From a policy perspective, we agree. Modestly inflationary, I think, is a very, very good term for that. Where we differ slightly, ultimately, is I think some of the underlying inflation data that has come in over the last 3 to 6 months, where we see there being a little bit of nuance that gives us some additional insight or hope, anyway, if we want to use that word, that some of the numbers within the headline reading, or even the food and energy reading on inflation, that some of those are due to parts of the inflation puzzle where there's more imputed numbers and less observational numbers. For example, shelter. I think we've had this conversation before at different SIOR events, but shelter is much more of an imputed, a calculated number as it relates to at least the CPI. And so there are some nuances that give our economists some additional level of hope that the Fed can actually maybe pull back another 50 to 100 basis points over the next 18 months or so. So our outlook just varies slightly there. Now, Shruti, I would imagine that your 10-year treasury, if you're using that as any type of a benchmark rate, if you have your Fed funds at 4.25 or so, 10-year treasury, the market has it at 4.5, 4.6 today or so.
4.75.
4.7 and more in an equilibrium state.
We're in a 4.75 on the equilibrium state, given the fact that we're staying on hold in our Fed baseline forecast.
Okay, so again, that interestingly, those numbers are very, very close. While we have the Fed funds actually coming down a little bit, we're at a point saying that the market really is dictating where the 10-year Treasury is and really where it will be over the next, well, really many years. And we believe they have it approximately right, somewhere between 4 and 5%. So again, this new interest rate regime is important. And it's very important for us in CRE because we've got to get used to this, right? I think a lot of us were on hold, especially in 2023 and early 2024, right? There was a big gulf between us in those that thought, or well, were hopeful anyway, that the 10-year Treasury might go down to 3% in the relative near term. And then there were others saying that, no, it might go up to 8%, right? But little by little, economists across different organizations, academic economists, we've all been kind of narrowing in, and the market itself has been narrowing in, that this is a new interest rate regime. We're in this for the long haul. That 10-year Treasury between 4 and 5%. Of course, depending on the extremity of some of the policies that we talked about, but generally speaking, our baselines are similar in those policies, that there was more campaign rhetoric than there will be actual extreme policies as discussed that were there. So we were looking at our CRE value index, and this is our sour slide here. I'll get to some sweeter slides coming forward. We've got work to do. This actually does set a new baseline for valuation within commercial real estate. We are more or less at, or at least near the bottom, but there's a little bit of market clearing activity to go through. And we believe that's already started and will continue through much of 2025. So let's talk about a little bit more sweetness, and that's on the cash flow side. That's on the income side of commercial real estate. That's on rent growth, occupancy growth. And what you'll notice here, we take a look at our core 4 property types. We include effective rent growth, 2023 and 2024, then forecast out the next 4 years. What you'll see here is that for all 4 property types, we do have positive movement on rent growth. We have acceleration of rent growth as the market comes into more equilibrium. We have a stable economy. We have a stable household labor market. The economy is going to grow at US potential, or maybe even slightly above. So we do have demand side that will support reasonably good rent growth, occupancy growth, not shown here, but occupancy growth over the next few years. And with higher interest rates, silver lining, right? We won't get as much development. So therefore, you have a bit of a balancing act going on right now within commercial real estate, because you do have valuations that have to, well, get used to the new interest rate environment. But at the same time, you have a pretty strong economy where you can have demand that will support income growth going forward. Okay. A couple of other themes we're going to look to throughout 2024 that's very important. One is activity growth. Here I'm showing a slide from Mortgage Banker Association. They do a lot of good work on originations. And across all 5 lender types here, we actually finally saw growth in the 3rd quarter of 2024, and it's very likely growth in the 4th quarter of 2024. That was the first time in 2 years that it happened. And the reason we're seeing this origination growth, the reason we're seeing transaction activity grow within commercial real estate, is more of a consensus on the economy and where interest rates will be. We think that will continue. Now, that won't continue without a little bit of distress, though. We have to clear the market where the math doesn't work anymore in this new interest rate regime, right? If we financed a new construction project or a loan at 4%, then we have to refinance that, or we have to finance the stabilized portion of that development. We're going to run into trouble. And with that consensus on where interest rates are and will be for the foreseeable future, then some of those keys are going to be handed back. Some of those refinancing are not going to happen. Now, this does not mean I'm about to forecast some kind of doom loop. We've used that word way too much over the last few years, right? That's where the media, I think, really hurts us. We have a spike in delinquency rates. We're going to continue to see a spike in delinquency rates, but it's going to be idiosyncratic rather than cause a contagion event, rather than systemic. This is not the GFC. This is not 2009, 2010, when banks were seeing delinquency rates around 5%, or CMBS was seeing delinquency rates around 10%. Not that at all. But we do have to get some market clearing, and ultimately that will be good for the industry, as that will help further transactions, and that will help us reach any bottom there is for certain valuations. Some more themes, more on the space market side. Apartment rent growth equality. I know this is SIOR, and apartments might not be your forte, but it matters because where people are, office and industrial, might do better, right?
Some of us sell family buildings too.
And thank you for that. So that's excellent. I've been on this, what's the word I'm looking for? Soapbox for a couple of years. And John, you talked about humility, but I'm not going to be humble on this one. The doom loop idea that we were all going to move away from New York and California and all move towards Florida, Matt, I'm looking at you, a Tampa guy, and Texas and Tennessee, right? That was way, way overdone, right? Yes, people move, absolutely. But for one, it didn't mean explosive or additional rent growth for those markets, at least in aggregate. There are certain ones that did, but take a look at the chart on the right. The one on the left is vacancy rate. We split this between Sun Belt and Snow Belt. Right? Obviously, Sun Belt vacancy's been going up. A lot of that's been the glut of development in a lot of those Sun Belt markets. But take a look at the rent growth chart. This is fascinating. Rent growth in the Snow Belt over these past 5 years exceeded rent growth in the Sun Belt over those past 5 years. That's a huge statement on the fact that we are in an economic market where supply and demand matter quite a bit, right? We have an expectation of demand out into the future. And trust me, a lot of that demand is still coming into the Sun Belt. I'm not about to stand here and say that I am bearish on the Sun Belt, but this is an economic market. You get a lot of development at near zero interest rates, especially where people get excited. That development comes online. Some of that demand is not as high as what some would have thought, certainly what the media would have purported. And you end up where you get not as great rent growth as you may have thought. Brookings did a really nice job on the last census. Don't worry about the chart on the left. Chart on the right, just focus on what I said earlier. California and New York, who were in their doom loop spiral, right? Everyone was going to move out and it was going to accelerate, and we were going to have nobody living here in New York or LA or San Francisco even. Well, turns out over the last couple of years, we actually had positive population growth in those states. Lo and behold, doom loop, maybe not. Now, I will argue, I will report, because it's fact, that a lot of the population growth that we saw in New York and California in 2023-24 time period, that was net in migration international in-migration. So if there are much more restrictive immigration policies, that could hurt some of this rebound effect that's going on in New York and California, but it's likely also to hurt population gains in Texas and Florida that are showing there as well, something we're watching in 2025 as it relates to the policies. Quick theme on office buildings. Another soapbox I have here. There are obsolete office buildings, but office is not obsolete. Right? It's a good saying. I'm going to give credit to that to my colleague Ermengarde Jabber, who, if you've heard her speak, I think she's done a couple of SIOR events. She coined that phrase in-house for us. And I think it's very, very important to realize that. And I think we finally have. Took us a while, right? Doom loop again, office. No one was ever going to work in an office again. Lo and behold, we're here in this building today, but lots of people are working in offices, and good, they should be, not just for our industry, but for the productivity of this country long-term, the innovation of this country long-term. I bring up Nashville and Chicago here. I could do the same thing for New York, but this is actually a histogram at the property level. And the bins of this histogram are vacancy. So all the way on the left, under 5% vacant. Nashville, many properties. Even Chicago, many properties. Those are not the absolute office properties that we're worried about. Some of them might move, right, to the buckets, but they're not obsolete. They're doing okay. What we're worried about is on the right-hand side. Even in a market that's relatively young from an office perspective, like Nashville, lots of growth in Nashville too over the last few years, you still see a spike there at over 35% vacant. Those we're worried about. We should be worried about. The office market's moving, it's evolving. Chicago, larger spike, but you would expect that, right? Given that Chicago's been affected a little bit more recently. They also have a lot more buildings from the 60s, 70s, 80s that might struggle a little bit in this evolved office market. And finally, my last theme here, 9 to 5 neighborhoods are dead. I am a big, big believer that mixed urban, and even mixed suburban for that matter, the densification of certain suburban markets, especially around transit, I think that's going to be huge. It's going to continue to be huge. And we're already seeing evidence of that in the data. This is an occupied stock index for office buildings. So that means above 100, more leased square footage than in 2019. Mixed urban, neighborhoods with residential, office, retail, et cetera, at more equal percentages than the traditional 9 to 5 office market. Those actually are seeing a lot of positivity when it comes to office. I'm a big believer that that theme will continue through 2025 and beyond as well. And thank God for society. I think we screwed up with a lot of archaic zoning laws that prohibited mixing of uses. Yes, we don't want heavy industry, maybe next to where we live, but light industry, sure, right? And certainly all kinds of other uses should be all mixed together. And I think that will create actually a better society, happier people too. I'm not going to get on that soapbox about philosophy right now, but I'm a big believer that that's a big help. Community is a very, very good thing. And it's a theme we'll continue to see in 2025. And so with that, I'm excited for the Q&A. Thanks, John.
I would say the beauty of both those presentations is that's been recorded. So we can go back to it and hear it again because that was fantastic. Thank you, guys. Okay, questions. Can Trump fire Powell and lower the rates by himself? No, just kidding. Question 1. The United States fiscal and monetary policy are not in sync with each other. One's trying to offset the other. And I think that's part of the problem we're having with the economy, where we're not getting the slowdown that we want because there's always another series of spending. Belinda Roman, PhD, Associate Professor of Economics at St. Mary University. Do you agree about this spending or disagree? Shruti, do you want to take it first?
Sure. Yeah, so before I go into, whether I agree or disagree, I think it's useful to just talk about how this really played out, right? So 2020, 2021 is when the big fiscal policy, measures, the CARES Act, the $5 trillion fiscal spending that happened to deal with the pandemic happened, right? So you had that happening in 2020 and 2021. Now, there is this phrase in macroeconomics, so more specifically in monetary macroeconomics, that monetary policy plays out with long and varying lags. As much as this is something I've specialized in, how long and how varying are those lags is harder to pin down, which is exactly what happened. I don't think these things were supposed to be offsetting by design, but they ended up being, because you had this fiscal policy measures that happened in 2020 and 2021. Then you had inflation going up. Some of it was supply because of COVID. Some of it was demand coming from, these policy measures. Then you had the Fed post the whole transitory versus permanent inflation debate, finally stepping in and starting to hike. Now, as the Fed starts hiking, because of these long and varying lags that monetary policy plays out with, or fiscal policy plays out with, you had the lagged effect of these policy measures that were enacted in 2020 and 2021 still play out in 2022, while monetary policy itself was taking a little bit of more time than expected to really work its way through the rest of the economy. So the big, I think, idea there is that when the Fed started hiking, the aim was to, bring growth slightly down, bring consumers slightly down so that you get a better handle on inflation. Why that did not end up happening, as much as we were expecting, part of the reason was that you had a lot of stability given to the consumer, to consumer demand because of these fiscal policy measures, right? People got checks in hand, they ended up saving those checks. There was no avenue to spend during the pandemic. You built this concept of excess savings, right? Savings that you built during the pandemic, which when the lockdowns were taken away, people were again free to go out there and spend on services, the revenge spending that the US consumer did. That is what was playing out in 2022 as the Fed was hiking and, but theoretically trying to restrain demand. So it wasn't entirely the way I'd put this, it wasn't entirely by design, but the way it played out, it so happened that as the Fed was hiking, you were seeing the lagged effects of the fiscal policy measures that were enacted to, help the US public through the pandemic, as well as some of the other acts, right? The CHIPS Act, the IRA, on the other hand, were bringing in private investment on the non-residential side of things. So both of those things, the lagged effect of the measures that were enacted in 2020 and 2021, as well as the CHIPS Act and the IRA, were keeping growth in the economy up as the Fed was trying to, restrain demand on all fronts and rein in inflation. Admittedly, over the last couple of quarters, we do think this effect has balanced out in some ways. You are seeing a labor market that's not, red hot. It's a little bit more stable. I was very cognizant of just consistently using the word stable when I describe the labor market, which is an indication to, this question that are we still seeing that impact really play out very strongly in the last couple of quarters? Admittedly, I think the Fed's getting closer. As Thomas also pointed out, right? I think the nuances of inflation, as much as it is a bigger concern for us more than growth, but yes, inflation has been able to stabilize. Primarily, one aspect of it is sure supply chains have eased, but also you've seen some, going from a red hot stage of the labor market, you've come to a more stable stage of the labor market that has helped with the overall outlook. Going forward, just to quickly point out, I think this might again become a problem because you are going to see a lot of fiscal stimulation, higher tariffs that are going to play out in the coming quarters. So this, again, these offsetting policies might again become a problem when you're in a generally sort of higher inflation background from where you want to be with respect to your target?
Thomas?
Shruti, you mentioned earlier, I think, a really important point on the relationship between the labor market and consumer spending, the chicken and egg, as you put it. And I think that's really vital to this. And you alluded to that in your answer, but I'm going to bring that back up. I think there was a little bit of a miscalculation of how balanced the labor market began to be in around 2016, 2017. I love to look at the ratio of job openings to the level of unemployed. And right around 2016, 2017, that ratio became very, very close to 1. And if it wasn't for the pandemic, that ratio was likely to remain close to 1, oscillating between 0.8 and maybe 1.2 or so, right? And we're kind of back there right now, right? That ratio is essentially at 1 at this moment, meaning there's as many job openings as there are people actively seeking work or have a job right now, so unemployed. And that stability in the labor market has really led us to, and this is where I'm going to maybe slightly disagree, where I do think the labor market is not cyclical, but I think it's more structural at this point. I think our demographics are such that we are in, for all intents and purposes, given the productivity and other things that we have, we are in a labor market that is very balanced from a structural perspective, and that's structurally leading towards 3.5 to 4.5% income growth or wage growth per year. And what that's going to do, that's going to pressurize inflation by itself, right? And that's going to make it so we are, again, in this new interest rate regime. So I like the question that was initially asked, but I'm gonna change it slightly and kind of say that I think fiscal and monetary policy, while they did offset each other, they brought us kind of to or through a very odd period. And we're coming out of the back end of that in a very stable economic environment that is based off of some structural changes in the economy that we didn't have post GFC, right? Or even in the early 2000s, when we had vastly different labor market metrics. I don't know, Shruti, you talk a lot about labor market. I'm interested to hear your thoughts on that.
Yeah, no, I think I completely agree with, one aspect of this, that I don't think this offsetting, which sounds like a bad thing, was necessarily a bad thing in this business cycle, right? When we talk about how did we, when the Fed hiked so much, inflation did come down, so it was able to achieve or get close to its goal of reining inflation. Why did we not see a recession? That's not something that is miraculous. It happened in some ways because of the policy measures that were enacted, right? So this offsetting was not necessarily a bad thing. You had these fiscal policy measures that created a stable, consumer and labor market environment, which helped in sort of, getting past that. If you spoke to me in 2023 or pretty much anyone on the street, everyone was forecasting a recession that did not happen. Why did it not happen, right? Because you had some of us were not as good forecasters. We did have a recession penciled in the early parts of 2023. Admittedly, I will take that win that we've been forecasting a soft landing since the summer of 2023. But why did that happen? That happened because you had, this consumer that came in pretty strong into the cycle of when the Fed started hiking. In terms of the labor market, I think there are two things going on there. From a more structural perspective, I agree there is a structural story in the labor market. That structural story for me is more from the perspective of labor supply. So when post-pandemic, you had this great resignation, then you had this big influx coming in terms of labor supply. Prime age participation rebounded to levels which we weren't expecting. Immigration went up above pre-COVID levels. And for a while there, you had this really positive labor supply shock that was keeping growth strong. we do think as we go forward, some of that story, some of that tailwind is going to slow down just because demographics by design will start offsetting. And I think we're already starting to see some of that. So I think that's the more like the non-cyclical side for me, that you had this rebound in terms of labor supply that acted as a positive shock in terms of keeping growth strong. As we go forward, I think that's going to become less of a story, and you're going to go back to the relationship. And I agree with you on that the labor market, the reason the consumer is strong, it's very hard to, really keep those two impacts aside, right? The consumer is strong. One aspect of that is because balance sheets are healthy. The other aspect of it is the labor market stable. It gives you wages and income have consistently been running above inflation, which is a positive for the consumer. So it's very hard to put those two things, piece them apart, right? So I think that's broadly where I would stand, that you did not have this miraculously good setting or like the good thing of the outlook that we're able to point out that happened because of the various policy measures that were enacted. Now, whether that was by design or not, whether that happened because it was someone so smart up there who figured this out, or was this because of the famous lags we talk about, that's, I think I'll leave that up to you.
Okay, next question came from across the pond, and that's why we have to ask it. Jimmy Mulhall, an SIOR from Dublin, asked, what are the factors, if any, that could negatively impact the ever-optimistic and ongoing U.S. global consumer spending free? He's got two parts, so that's part one. Who wants to?
I'll go with the more macroeconomist here.
Got it. Okay. So everything that I have said, and that's the reason when I was doing the outlook, I did not go into a lot of the nuances because I knew it was going to come up in the questions. So yes, there are a lot of things which are very positive about the consumer. As I said, a labor market that's healthy, that gives you wage and income gains, which are positive, balance sheets that are overall looking pretty healthy. The one thing in all of this, which I, every month, which I look at with bated breath and I keep a very sort of, a close eye on, is delinquencies, right? Credit card delinquencies have been increasing. I know they make the news very sensationally. Whenever that number comes down, we try and put that number in perspective. As much as that's going to be one of the big factors, that's going to be an indicator of whether if the consumer is going to be falling or, going down in the coming quarters, I think it's important to put that number in perspective, right? Currently, we don't think it's the biggest worry factor, given the fact that highly delinquent debt as a percentage of disposable income is still only 0.6%. If you look at where it was pre-pandemic, it was 0.5%. So even if consumers want to go back to where they used to be pre-pandemic, that's still going to just shave off a couple of tenths of consumer spending growth that we're forecasting. The other aspect of it is, yes, credit card debt, makes the news, but in terms of of its share in the overall consumer debt, 70% of overall consumer debt is mortgage debt, where given the fact that you're in this high interest rate environment, people are still locked into low fixed rate mortgages from before the pandemic. So a big part of why the consumer remains strong, the fact that people are locked into low fixed rate mortgages is a negative for the housing market in terms of supply. But for the consumer on net, it ends up being a good thing because in the US, you don't feel the full brunt of the Fed hikes or the high interest rate environment as much as you would do in a lot of countries where the housing market is not such a big fixed rate market, right? So I think that's definitely something that we keep a close eye on. If delinquencies go up, especially right now, we're seeing them go up in the lower income consumer sector, which is obviously not a good thing, but in terms of the overall macro environment of consumer spending, the lower income consumer spending is still a small share. So the way I'd put this is, yes, we're a little bit worried about that aspect of the consumer with delinquencies going up, but I would be, a little more doomsday about this if that had spread out to other income cohorts, if that had gone on to numbers which were much higher than where these numbers used to be pre-pandemic. And then again, I think the other risk factor to the consumer is going to come from the labor market, right? If the labor market right now, something that's sort of, I think, this is where we, might agree or disagree a little bit, is for us, something that's really sort of, keeping that plug on the labor market is layoffs. Layoffs are currently low, have been low. That's allowing a stable labor market, a stable consumer. That falls, we think that's going to have a cascading effect on the consumer as well. So those, I think, are usually when people ask me in all of this noise, what are the two big things to look at? I'm like, layoffs from the labor market side, delinquencies from the consumer side. Both of those things as of now are stable, but important to watch out.
That's fantastic. Let me just add to that really, really quickly from a real estate perspective, the point of the delinquencies being more segmented towards the lower middle income group and the lower income groups in this country, right? From a social perspective, not a very good thing. Overall, from an economic perspective, we agree that should not be a major, major factor. From a real estate perspective, we get asked about, oh, will this affect Class BC housing? Will this affect neighborhoods that really focus on lower income households? And we have a saying in real estate, and that's rent eats first. And so you look historically, delinquencies will actually rise for credit cards, auto loans. You'll see a lot of those issues, but rent will continue to be paid quite a long time into that economic cycle, right? Into any type of downturn that there could be. And so, you know, we're still in a situation with in Class B, Class C, rental housing, for all intents and purposes, frictional vacancy, 3% vacant across many, many, many of our markets, even nationally. I think it's very, very close to that level. So there's a lot of softness that could go in that direction for Class BC housing. The second thing that I'll say, and I'm hoping to back you up here, is the second ratio I look at from a household budget perspective or household balance sheet or household health perspective, why I'm not so concerned about the US consumer generally, debt service. Right, so essentially the payments we're making on that debt as a percentage of disposable income, not any higher than it's been over the long haul. Savings rate, almost as a percentage of disposable income, almost equal to that debt service percentage. That's a good sign. Leading up to the great financial crisis, you had a situation where debt service payments as a percentage of disposable income were twice, if not greater, than that of the savings rate. And you can argue a variety of reasons. I'm sure Shruti knows that from a historic perspective of why. But for me, that means there's no buffer. If there is an economic shock coming, there's absolutely no buffer for many, many households if that savings rate is so low. And therefore, that's when you end up in a non-virtuous cycle that could take down the economy. I think we have a big buffer right now, a reasonably large buffer. In 2022, there was a lot of media attention on the plummeting savings rate. Well, for one, it was coming off of all that stimulus that Shruti, illustrated earlier, discussed earlier, right? We also in 2022, what did we do? We bought single family houses at a near unprecedented rate. We dumped all of our savings into that from one last, right, attempt to get into a single family home. Since that point, the savings rate has been coming back up. We actually have somewhat responsible US households right now, which is not always the case, right? So I do think, we're in a reasonably good situation here.
That's it. The session's over.
What?
It's 3 o'clock.
No, John.
What? We just heard we're safe, so that's when you want to end. Wonderful, guys. Thank you so much.
Thank you so much. Thanks for having us.
We're going to take a 10-minute break for everyone to take a 10-minute break.
Thank you so much. So much credit has to go to John Stravitz for, first of all, conceiving of this as a possibility and carrying it through with literally 2.5 weeks ago with the birth of his son. His amazing energy is infectious. I have to thank the leadership team for the NYC Downstate chapter and helping to coordinate and put this together along with SIOR Global. Thank you. But truly, this is an international audience here this afternoon. We have people in the main room. We have people in the breakout rooms next to us. But we also have over 100 people across the country and throughout Europe who are sort of watching this and viewing this. And the kernel for this conversation started with Jimmy Mulhall, who's from Murphy Mulhall in Dublin when we were in Berlin over the summer, and then carried forth with Trip Gwynn, who I hope is joining us as well. And Trip is in the Charlottesville market, Trip Commercial. This is a topic that is just not only referencing New York and New York City, but across the country and actually across the world. So it's a conversation that we've got this amazing panel to talk about their experience and the partnership between government and developers and how this all fits together and what it has to look like. We have Melissa Roman Birch from NYC EDC. Melissa is the EDC's Chief Operating Officer. She leads the Real Estate Transaction Services and Asset Management Division. As Chief Operating Officer, she oversees the public-private developments involving city-owned property and manages EDC's portfolio of over 200 unique and iconic assets, spanning 64 million square feet and composed of commercial and industrial real estate, critical infrastructure, and energy assets. She also leads the Strategics Investments Group, which structures impact investments through discretionary tax benefits and tax-exempt financing, and initiates catalytic investments that mobilize private capital and support the growth of strategic sectors. I want to hear a lot more about MSMX, which was just announced, and City of Yes, and how this influences the conversation. Sitting to Melissa's left is Robert Fuller. He is a principal with Gensler, manages their residential practice. And Robert is the global leader of the residential practice with a background in architectural design as well as city and regional planning. He leads the studio in the firm's New York office that specializes in large, complex projects that include planning and urban design, new buildings, building repositioning, office to residential projects, conversion projects, and mixed-use developments. And in terms of like Gensler being a leader for this at the Hollywood conference for SIOR, we had another one of your colleagues who was speaking as a principal out on the West Coast. So Gensler is definitely the thought leader here when it comes to creatively coming up with ways to reuse obsolete assets. Next to Robert is Daniel Berman from Metro Loft. Daniel has been with Metro Loft since 2006, which he's had the opportunity to work on the design, development, and management of over 2 million square feet of residential conversions, including 20 Exchange, 443 Greenwich, 20 Broad, 180 Water Street, 116 John, 63 Wall, and 67 Wall. He's currently working with the development team on 3 new projects comprising of approximately 2,300 rental units. He's overseeing the management of Metro Loft's existing portfolio and identifying and underwriting future office to residential opportunities.
Sorry, a small correction. We're working on 6 new projects.
Fantastic. No, that's awesome. And to Dan's left is my friend Brian Steinwurzel, co-chair or co-CEO of GFP Real Estate. Brian oversees all aspects of the company's new investments, financing, leasing, and asset management, development, and project management. Noteworthy recent projects include the repositioning of 4 New York Plaza to 25 Water Street, 222 Broadway, 7 Hanover to 100 Pearl, and 40 Exchange Place in the Financial District. There are some commonalities in these addresses here. So we should also mention that sometimes these guys collaborate with one another and sometimes maybe they compete against each other, but we'll get to that. I want to, open and set the stage and just throw a question out to all the panelists. New York City's office vacancy rate remains elevated. However, how critical is office to residential conversion in addressing both the surplus of office space and the city's housing shortage? Is this unique to New York City, or are there broader national implications? So, you want to kick things off, Melissa?
Yeah, I'm happy to get started with that question. Thank you. Great to be here with you all today and looking forward to the dialogue with my fellow panelists. So it's a great way to start the conversation because coming out of COVID, New York City, which is not alone in recognizing an opportunity to think about office obsolescence and the connection to a potential contribution to the housing supply crisis that New York City finds itself in and that many cities around the globe find itself in. But I want to just maybe step back for one moment on framing, which is to say that the solve for the 100 million square feet of office space that is currently sitting vacant in New York is not that it all converts to residential. New York City has seen an extraordinary economic recovery coming out of COVID. I want to let everyone know that we are at a record number of jobs in the history of the city ever. So this isn't just getting back to where we were pre-COVID. We're now over 75,000 jobs higher than where we were at the previous peak, with strong growth in healthcare, professional services, and finance. I mention that because despite the fact that we are at an all-time high for jobs, we still find ourselves with excess office space, and obsolescence is an issue. That said, we actually have too much Class B and C office space and not enough trophy office space. That'll be the topic for another panel, but I did want to acknowledge that the EDC has been supporting tax abatements that we just announced one this morning for a new building at 460 Park Avenue for offices that are aging office buildings that want to do dramatic modernization efforts to become better office buildings. So that is an important part of the strategy. And it's a multi-pronged strategy. So not only do we need higher quality office, but we need to remove obsolete office from the office stock. And many of those can be converted to residential, not all of them. But we certainly need to find ways to adaptively reuse them, whether it's for residential or whether it's ultimately in some sort of a demolition, a combination assemblage and a redevelopment. So all of those strategies are being employed. And last year in 2024, the city worked very closely with the state to effectuate the 467M tax abatement, which is specifically targeted to enable office to residential conversion. And we can talk more about that. What it does do is make sure that if you are going to convert, that 25% of those units could be designated for affordable housing, which is bringing affordable housing and housing deep into the central business districts and the city's core.
So we can continue on, or I can ask a more pointed question to the other panel members. Just
If I can
yeah,
add,
please, Dan, go ahead.
The latest census shows that by the year 2030, the city is going to be about 500,000 units shy of demand. That equates probably to about 80,000 units a year, or I guess if we're in 25, 100,000 units a year. I don't believe there's any other solution other than office to residential conversion that can meet that demand. I don't believe that demand can be met regardless, but with the ease of conversion relative to ground up construction, and I don't think there's any other way to really meet that demand.
Thank you.
I think that's an interesting comment, and I think it's a critical part of what we need to do. And I'm happy to share more details on this, but the city is looking really at a strategy of everything, everywhere, all at once, which means that there is no one silver bullet to the housing crisis. I'm really glad you brought up the $500,000 unit shortfall, which that is what is estimated is needed to meet not only the existing shortfall of supply in New York City, but to also plan for the growth that we are expecting will happen by 2030. So in addition to office to residential conversion, we have undertaken in the year 2024, one of the, well, the most ambitious, and it's now fully approved, change to New York City zoning code. It's called the City of Yes for Housing Opportunity. It passed in December. It is creating zoning to enable 80,000 new units of housing across the city. Every neighborhood is touched by this and is effectively enabling a little bit of housing everywhere so that we are not only relying on the high density districts to supply new housing supply.
Yeah, I just want to add, so I think all these points are really good. So I'm Brian Steinertzoll. GFP is the largest landlord to small and medium-sized businesses in New York City. And we also are a prolific developer that is agnostic towards use type. So right now, I think we have a great moment in time. There's been a very strong partnership between city and state and private development to come up with 467M. And what Melissa's talking about with City of Yes is really an amazing step forward. This administration deserves a lot of credit for doing that. And this administration is also, and I hope they are successful, and we should all hope they're successful in their rezonings. I think there's 4 in Manhattan. There's 1 large one in Long Island City. There's a number of different efforts throughout the city. And those in combination, I think, can help to alleviate some of the housing crisis. But I think Dan is correct in saying that even with this multi-pronged approach, which I think is fantastic that the city has undertaken, and I hope that the state continues to provide the encouragement and the financial incentives to do it. Even with that, it'll be very difficult for us to overcome this demand. And, thank goodness we have that demand. It's great that New York City is as strong as it is, and there's that many people that want to live here. And now we all have to, industry, government, have to partner to try to figure out how do we resolve this so people continue to want to come here and can actually afford to live here once they are here.
Yeah, so I want to get to Robert, but before you weigh in, Robert, to the developers at the table, what are the biggest economic and logistical hurdles that you face? You're looking at a building. How do you decide that this is a good building to make an investment in?
I guess I'll start. The primary criteria that we evaluate is the project as of right. Prior to City of Yes, that meant that buildings built in Midtown prior to 61 and 77 in downtown New York were completely as of right, meaning you can build full FAR residential without regard for any commercial tenants on top. You can build on the same floor, below, above. Buildings that are not as of right are more constrained. So for example, the ones that have not as of right projects that have a commercial tenant at the top, you can't convert at all. So I would say that's the primary criteria. And really, the other main factor is obviously the price. We have a lot of creative solutions to adaptively reuse a lot of different, types of buildings, different layouts. So it really comes down to being able to have kind of carte blanche to do what you want.
I think he's absolutely right. And from our perspective, and Dan and Metro Loft have probably the most experience out of any developer. I think even the numbers that Ken was quoting are probably understated given the projects that Dan and his group are doing right now, which is really quite extraordinary. But I mean, from our perspective, the number one criteria after as of right is just the cost of the project. Because at the end of the day, it's really a flow of capital that has to make these projects worthwhile, and they all have to pencil out. And the risk of doing conversion is much higher than the risk of building a building out of the ground, right? There are so many unknowns that occur within these assets. And the trick to a successful project, there's many of them, but one of the primary ones is making that building as efficient as possible. And the risk that you're taking by buying an existing building, potentially having a lot of tenants involved that have to vacate or at least be worked around to make the successful project, then making it efficient, and all the while capitalizing it in a way that makes you, the developer, along with your partners, the equity, the debt, profitable is really a very complex project.
Yeah. So Robert, I know Gensler has an algorithm so based on site context and building form, floor plate, envelope size, and servicing and such. what are the key architectural and design considerations that these guys need to consider when looking at a building so that the project can pencil out, as Brian alluded?
Yeah, I think, just quickly on the algorithm, yes, we have this tool that we developed, several years ago. It's gotten a lot of publicity, given all the talk around office to resi conversions. I will say this, what that was developed for and what it's useful for is sort of, we use that, we're working for the public sector, like evaluating all of downtown, right? And they don't have the time or the money to have us look at each building individually. But it's not the end all be all, right? In the end of the day, nothing beats just sort of the experience of actually doing it. And it was also developed sort of agnostic to any geographic location, right? Because we developed it originally for a study with the city of Calgary. We've since worked for San Francisco, Denver, and lots of other places. So it's had its use, but I get people calling me, say, can you run my building through the algorithm? And I say, well, I could, but it's going to be marginally useful because, again, New York City zoning, is it as of right? All those things I would argue are even more important than the physical layout of the building. Yes, you got to look at floor plate depths and sizes, light and air, legal light and air. But tying back to the financial conversation, we have yet to find a project that didn't move forward because we couldn't come up with a creative design solution. It's something underlying in the finances that make projects go forward or not go forward. We've got
That's
a lot
the
of
tension, right? It's that, you've got to be able to pay for it.
Exactly. So I think it's important, as designers to understand that, from the client standpoint. Yeah, you want a beautiful project, but you have to understand how to make those efficiencies make the project work. And so there's a toolkit of strategies that you see happening in conversions that are happening around the city, whether the blind shafts we did at Pearl House at 160 Water to carve out inefficient floor space and relocate it, the light wells at 25 Water to open up more legal light and air for more units. There's lots of things. We're carving out a notch on the building at 753rd with SL Green right now to make the floor plate more efficient and reutilize that floor, in a more valuable way, reutilize that floor plate. So there's lots of creative solutions to it, lots of creative unit layouts that we can do, but the underlying finances of the building are really what make these projects happen or not.
So can you take a step backwards into, for those that are watching this overseas or that are not in New York, can you describe what that is in terms of creating those light wells and what the value, why you do that? What?
Sure. I mean, you can imagine on these large floor plate buildings, you can only make a unit so skinny and deep, right? And so you have these deep, dark parts of the floor plate that are really not suitable at some point for unit planning. So if the floor plate is large enough, you could potentially literally cut a hole in the building, have units face it, but that has to be a certain size and dimension to be considered, for legal light and air here in New York.
And then are you adding that floor area to the?
More often than not,
losing it?
whatever we carve out, we're then relocating that floor area to maybe to the top of the building, building additional floors on top, which are quite valuable floors, you can imagine, right? So.
Dan, do you want to weigh in?
Yeah, I would add, so I have the great privilege of working with Brian on probably the most difficult and seemingly impossible conversion that we've ever seen, at least. It's a building that's approximately 300 feet deep by, I want to say 160 feet. So it's a little bit larger than an acre. And the fenestration when we purchased the building looked, like a Soviet prison with red brick. And I think most developers, probably all developers except for us, looked at it and were frightened and turned the other way and ran away. Not to mention the building only had 2 legal sides of light and air. So, the creative solution that we came up with was to create 2 light wells on the floor plate, essentially carve, it's basically alchemy. You take useless space that would be too deep for apartments, you carve it out and you create legal light and air in those courtyards, and you build that square footage on top of the project, turning garbage into gold, essentially.
I think it's important, again, thinking about your folks calling in from other areas. We keep saying legal light and air. Important to point out in New York City, you need, in order for a bedroom to be called a bedroom, you need access to an operable window that has light and air, access to light and air. There are other jurisdictions, we've done conversions where, that are more IBC based, straight IBC based codes. You can have bedrooms deeper into the floor plate where that's less of an issue, but in New York City, it's sort of critical to making these work.
Well, also, operable windows is a potential issue when you have buildings, especially of the vintage that Dan mentioned, that have a lot of glass curtain wall, and how the expense that's invested in defenestering and adding new windows.
Yeah, for sure. And, that said, again, creativity, right? I think we've seen a couple buildings that our first thing was, oh, we're gonna have to completely rip this skin off and redo it. Yet we figured out a way to retrofit the facade at 160 Water, where it was a retrofit, not a full reskin, which, helped keep the cost down and make it also speed to market's a huge part of this, right? Getting the construction done, in 24 months, you can be occupying apartments. If you were doing ground up, it would take you much longer than that, right? So back to that, stabilizing the project and having that work with your lenders is, I think, a huge driver for these as well. But I think, the deep floor plates, the facade work, I think these are all things that we always hear about. There's no shortage of ways why you could talk yourself out of conversions. I think you just have to make sure you have the right team in place that knows how to get over those hurdles, and they become much more viable than at first glance.
So Melissa, bringing this back over to the city side of things, as you're trying to, create this mandate and provide a service or provide apartments for people to occupy, what's the conversation internally within government in terms of the best way to do this?
Sure. So, it's certainly multi-pronged, and I just want to add, I think, before we talk about sort of the current state of play, just to remind folks that office to residential conversion is not new in New York City. There's certainly a lot of excitement around this sort of recent burst of activity that's come out of what has been a new opportunity, which is all of this office vacancy and obsolescence. But our first office to residential conversion program took place in New York City in 1995 in Lower Manhattan. There was an incentive that was a tax abatement put in place by the city and state that resulted in 13,000 units getting converted and created in Lower Manhattan, starting in the mid-90s. And what's so amazing to sort of remember is that the reason why an incentive was needed at that time is because it was very hard for anyone to imagine that anyone would ever want to live in the financial district. It's like almost unfathomable now because it's such an accepted neighborhood, and it's really a great Manhattan neighborhood. FIDI has so many resources and is so mixed use now. But at the time, it was a very sleepy financial district. I mean, sleepy after 5 p.m. And it was untested and unproven if residential would be viable. Well, not only was it viable, 13,000 units were converted with the incentive. Another 18,000 were converted without the incentive. After the abatement expired, more conversions continued to happen. So I think from that perspective, government really felt like it was an appropriate catalyst to stimulate the market and help lower the cost of investment when something was unproven. And then, projects continued to move forward because the market strength was there. The intervention that we're seeing at this moment in time and why we've introduced an incentive is not to enable conversion from office to residential for projects that are 100% market rate, but to provide an incentive to get developers to add some amount of affordable housing into their project. So that's the piece that we think is needed to be incentivized this time around, is introducing affordable units, not just enabling the conversion in the first place. We believe that the market opportunity is there. But we didn't just sort of let it go on its own. We also had to be a catalyst to create it. And that's where the zoning is so impactful. You hear Brian and Dan talk about the importance of as of right. What the zoning does is it makes these projects as of right without any further government discretionary approvals. What do I mean by that? We changed the date by which all office conversions are allowed to occur. The date used to be that your building had to be older than 1977 in Lower Manhattan and 1961 in Midtown. I mean, somewhat arbitrary, but now those dates have been changed, and now it's 1991 or older. So just by shifting the date, we actually opened up 138 million more square feet of office space that could be eligible to convert. You know, the developers and the capital markets have to decide if they want to undertake the project, but the zoning enables it. And we also broadened it so that it's not just in the central business districts. It's citywide, anywhere where residential is permitted. So this was a dramatic expansion of the amount of product that could be a candidate for a residential conversion. So couple the zoning change with the incentive for affordability, with the lifting of the 12 FAR cap, which now we are getting like really into the weeds of New York City, but this is a New York City panel, which just effectively there's been an artificial cap on the amount of residential that can be developed on any one site to a floor area ratio of 12. It's been codified in state law for decades. That has now been lifted. So there is now no cap, which means that whole office buildings can get converted. Many offices are like 24 or 36 FAR. So now the whole building can convert, whereas before only a portion would have been able to. So you know, all of this is in the weeds because, to be honest, like the value creation is in being able to unlock the details of land use, you know, incentives, finance, design, you know, how do you bring all these together into a project that actually makes sense to undertake. But Ryan mentioned the criticality of this sort of public-private partnership, and that's very much been the spirit that the EDC and the Adams administration has been taking to put into place these incentives. All of this has just happened in the last 12 to 24 months, and it was done with a lot of workshops and focus groups with the private sector to understand what moves the needle for you. Like what, you know, if we did this, would that be helpful? You know, and then the private sector would come and say, oh, well, there are these other things that you should be thinking about that you haven't really addressed yet that are important to us and are, you know, potentially going to help make projects pencil. So it's been very iterative. And I think that we've landed at a place where 2024 was the year of policy change. And now 2025 is going to be the year of projects getting launched. That's my prediction.
I think everything you said is absolutely correct. I think the interesting thing that will occur now is with the incentive that was put in place for affordable housing, and I do think to spur conversions, in order to get a permit and qualify for that program, you will probably have to file by this summer. And I'm talking probably in the middle of the summer. If you do not file prior to that, you probably will not be able to get your Alt 1 approved and qualify for the incentive program. And I think what's happening is there is a lot of units that are racing to file, qualify, get permitted, and get built so that they qualify for this incentive. And it'll be interesting to see after this period of time how many more continue to do it. And I think it will become a factor of how much the existing ownership and really the existing debt on these office buildings decide to transact at a market clearing price. And, you know, for prior to the incentive, there were some, Dan and I partnered on a project, a 1,300 unit project, the one you described, that was supposed to be a fair 100% free market project. We ended up opting into this. I think we're the first building to opt into this program. But without that, there weren't a lot of projects that were going to be done. And I'm curious to see what will happen, you know, after this year, if the market does start to clear, that lenders and existing owners will sell their buildings at prices that make it financially feasible to do the conversion, or if the office market continues to improve and these buildings actually remain office buildings and remain successful office buildings. And it'll be fascinating to sort of watch. We own a lot of office buildings, and we own now a lot of conversion projects. So I think we're at least aligned to benefit either way.
Yeah, that is interesting, Brian. It also dovetails into a comment from Jimmy in Dublin about, you know, whether it's in Europe and in other areas of the country, there aren't incentives to facilitate conversion. So, you know, to what degree are the incentives necessary to make this happen, which I think you've addressed. in as much as that it is a big question, but are there other big items that the city can help with or add, some heft to make your process more streamlined and easier? Or is that fire code? Is that, what?
So like the most expensive thing that we have, the thing we spend the most money on is actually time, right? So if you think about the cost of capital blended between debt and equity, you're probably looking at mid-teens cost of capital, right? So if you can't underwrite getting higher than mid-teens returns with including debt, so on a cash only basis, you're probably not greenlighting your project. So speed to completion is probably the most valuable thing. And one thing the city did was they actually created an office to residential conversion accelerator, and they assigned staff to do that, to basically help us and help coordinate our efforts to get approvals done. Simultaneously, the city and the Department of Buildings have actually done a really good job about having a group that takes large projects and has basically a department dedicated to getting those projects permitted and approved more quickly, and also getting the, basically getting the sign-offs done as well. And I think, hopefully fire department, DEP, other divisions of the city start to follow this model as well. Because if we can reduce, like right now, from the time you file the Alt-1 and you file the Alt-1 as a permit process to change the use of a building or to build a building, from the time you file it to getting an approval is still at probably 8 months. And it could be longer, it could be 12 months. And that's after you've completed your drawings that are appropriate to do the filing. So if you can compress that time frame, then the returns to us will go up. That means that we can pay more for the land. There's more likely those transactions will clear, and there's more product that will get created. So, there's a good start from this administration, and hopefully that continues.
So from a financing perspective, maybe Dan, you can speak to this. How do you get these projects financed given the amount of time that Brian just outlined?
I think, as Brian very aptly said, time is our most valuable. It's the most valuable thing we have. And so on all of our conversions, our pre-development process starts it starts the second we catch wind of a building being available. And so in that sense, we try to get ahead of financing. And I'll say that, in this environment, although rates are a little bit elevated, a little higher than I would like, it's a feeding frenzy, and the lenders are really going after great sponsors like us that they know can complete a deal. And so I think it's not as challenging as you may think.
Okay, that's good to know.
You have to understand that his group has completed 20 of these projects. So I think when a lender or equity sources are approaching groups like MetroLoft and hopefully GFP, they're looking at them with a lot of confidence that it'll actually get completed. And plus, these guys are signing personally on the guarantee, or at least they have in the past. So there's
no comment.
So there's the confidence that they're putting their name and their balance sheet behind their projects, and they're successful as a result.
Thank you. Robert, do you want to take a step aside and talk about how you use underutilized space or space that isn't now converted to a light well? How do you make these buildings attractive that people will want to live there? Are there amenities that you're seeing a commonality in, or something that strikes you as a good way to use otherwise difficult to convert space?
Sure. Yeah, I can give a couple examples. I mean, again, there's no one size fits all. I think although the challenges are recurring, the solutions sort of vary project to project. If cutting out and making kind of those larger surgical additions and subtractions in the building don't work for whatever reason, whether it's financial or something else, there are other things. We did a conversion in Philadelphia where it was a traditional center core office building, and the units laid out quite efficiently because there was a reasonable planning depth. But in the center of the core, where the old core restrooms were when it was an office building, it's like, what do you do with that, right? And we were struggling with that a little bit. And So like there's, you can put tenant storage, right? If you're a young renter who has a small studio 1 bedroom, it's really valuable to have a storage locker down the hall, and it's revenue generating for the clients, right? So we're seeing a lot of that. But in that particular project, the original plan was to do a full floor of amenities like you do in a lot of projects. And we started saying, well, what if we stack the amenities vertically in those spaces? And even a couple of them, we opened up as double height spaces. So we ended up with this sort of vertical spine of amenities that sort of culminated with this new rooftop amenity pavilion. So it was sort of an interesting way to distribute them through the building. But what it allowed our client to do was take the floor that was originally earmarked for amenities and get 24 more units, right? So it just helped the overall finances of the project. So you just have to kind of think a little bit differently about it, but it is tough. You know, some of these buildings are challenging. So sometimes it's a mix of these strategies, you know, combined on a given.
Are you seeing co-working as an amenity that you're?
Yeah, for sure, especially, you know, the recent, you know, work from home sort of boom, although as many of the previous speakers talked about, I think the office is alive and well. But yes, I think co-working as part of the amenity package is pretty standard, I'd say these days. One of the most used amenities in our 160 Water project, which recently completed, is the Zoom rooms. We did, kind of these sound isolated rooms that you can sort of reserve and go in there and have business meetings on throughout the day. They're packed all day long. So absolutely co-working is a big part of it.
Melissa, from an optionality perspective, how much space can be converted to residential? Are there other aspects that developers with a sharp eye might consider converting their buildings to other uses, healthcare, education, so on and so forth? What's EDC's perspective on that?
Yeah, it's a great question. When we look at that 100 million square feet of vacant space, we think about 30 million of that will get converted from office to residential. I mean, that's just a guesstimate based on looking at, previous programs, looking at the 1995 to, year 2000 runway. We're not capping it at 30 million. So maybe we'll be surprised. And Brian sort of talked about that calibration of, as the office market improves, then, these dynamics are very interrelated. But it does then leave you with quite a number of square feet that you need to ask yourself, well, what can we do? Now, some of that space will get invested in, and that's what our MCORE program is doing to help owners make transformational investments of their office from lower quality office to higher quality office. So some offices just need capital improvement and, they need a huge infrastructure upgrade. I'm not just talking about putting new furniture in the lobbies. I'm talking about local law 97 compliance, about, new facades, new energy systems, amenities floors, et cetera. But then we are seeing, and actually I've been very excited to see developers pursue projects. We've seen a lot of academic users come into office buildings. A couple of years ago, in an EDC project with the Rudins, they repositioned the former Reuters headquarters building into a vertical campus for Touro University, right there in the heart of Times Square. I thought that was actually very exciting because I think that our districts will benefit from more mixed use. So the more combination of uses that we're bringing into them, the more vital they will be. So I love the idea of academic users coming into some of these spaces, but we're going to see all different types of repositioning. And when I look at, all different types of adaptive reuse. And I think that when I think about New York City's office space, our office sector is quite old for a New York or for a US city. Or the average age of an office building is about 80 years old. And so we need to get a lot better at thinking about adaptive reuse, because what made sense for something 60 years ago may or may not make sense today. But the answer should not only be tear it down. Like, we have other goals around decarbonization and sustainability, and these older structures, as we've seen from many examples of European cities that have done adaptive reuse really phenomenally well to bring new mixed use types of spaces into older structures.
Thank you.
I would just add that, you know, a lot of these older commercial buildings were built to a much higher standard than you would see today in new construction. You know, be it the slab depth, you know, the slab to slab, which impacts the ceiling height. They have great fenestration, over elevated. So, you know, the structural kind of foundation is there, and it's in many ways superior to what you could afford to build today. So I think that's important to keep in mind.
Older buildings are superior to what you're building today, is that?
In many aspects, yes, because first, you know, not to mention the fact that you have an existing superstructure, which is basically a topped off construction site, but it has more elevators, you know, it has, in many cases, it has a lot of elevators, you know, it's overly fenestrated. The slab is thicker than what you can afford or what zoning requires today. So better sound attenuation, you know, and the ceiling heights are generally, you know, 11, 12 feet, which
So
can,
when you go in, follow-ups, when you go in, do you mess with that or do you like keep that in place since it was superior to you?
we generally, unless we're cutting out a courtyard or we're changing the structure, we generally strip everything to steel and concrete. So all the mechanical systems, you know, everything gets stripped out, but the structure remains. And the fact that you have an existing structure, when it would take you many, many years, I think, you know, 4 or 5 years to get a new building out of the ground, I think that's very impactful, especially with the cost of money.
So that's part of your economic analysis when you're looking at a project in terms of, as Brian's point, the speed to market. I wonder, as a follow-up question, how do you look at submarkets then? How, you know, what's the Metro Loft, GFP secret sauce, and you've got a room full of brokers. You know, what are you looking for in a project?
I think that we said it earlier, but and Melissa said it earlier as well, is that we're looking for as of right projects that are of a certain scale, right? Because if you're going to undertake this kind of effort, you really need to have scale. And for us, it's rare or unlikely that a project that's under 300,000 square feet would probably pencil out. 300,000 office square feet, which is again less residential square feet. And then look, we're looking for something that can be converted as of right, that also is at a price where it economically is feasible to do it. The projects that we've done, Metro has done some condo. We had done condo in Brooklyn in a past generation, but generally these are rental product, right? And so you know, you're looking for markets where there's actually growth, and it's okay for us if there's growth in supply, because we believe that as neighborhoods grow in number of units, they actually grow in acceptability to the end customer. And then as neighborhoods become more acceptable to everyone, there's actually more demand that comes to those neighborhoods. So, you know, generally neighborhoods that are in that path of growth are something that we're very attracted to.
Maybe I can add to that. You know, so we have 57 offices, our firm, around the world, and I get calls from our, and we're studying this in most of them, right, to some level. Yet very few probably have gotten the kind of momentum that New York City has right now. And so I get these calls all the time. Well, how do you make it work? You know, New York, and you know, it's all the stuff we're talking about, right? It was the mix of it was the delicate balance of zoning, incentives, as well as continued, you know, valuations coming down, right, as they have over the last couple of years, that have sort of all come together to this point to hopefully catalyze this moving forward. A lot of other municipalities haven't done that as good a job of balancing all those things, and it's also just, in my opinion, shows to the, you know, the positive long-term outlook in New York City, right? Investors are willing to invest here because they think there's long-term value. And so some of my colleagues in other areas are struggling with that because you know, there's just not that commitment. So they're in the kind of mode, you know, we did a panel a couple of years ago and I was complaining about the endless amount of studies we were doing, but how relatively few projects. Mm-hmm. Now I'm happy to report we've got our hands full doing plenty of projects that are actually moving forward. Our colleagues are still in that study mode, seemingly endless loop of analyzing buildings and realizing that, you know, they're not moving forward for whatever reason.
Yeah, I think the learning curve is really steep. So once you actually do a project or two, then you learn a significant amount. Until you've done that, you're really far down that curve. And you mentioned there's brokers that are listening here. The number one thing I would take away from this, that I would tell your customer, client, partner, whoever it is is that unless you start that project today, you will not be done in time to qualify for the 467M program. There's 3 phases to it, and I know that there's.
I was just about to jump in
there's 3
to
phases
say
to it,
that.
but the economics.
Well, there's 3 phases. It goes until 2031. And the economics of it burn down over time. So the first, and between now and 2026, you get a 35-year abatement. And then a couple years after that, you only qualify for a 30-year, and then it burns down to 25 years. So yes.
So she's 100% right, but your customer, your client will lose that value of that first phase, which is by far the most valuable one, if they don't do that transaction now. And thinking, oh, it's June 2026. No, and even this is one of the best in the industry. You hired him today. I think he's fighting to get that approved by June 2026. So,
But I'll try if anyone wants to.
but if you don't make it, it's still there, but the value will be lost just by not starting early enough.
So you lose 5 years of tax abatement value is
Yes.
essentially, yes.
Yes.
Yeah.
We've structured other programs like this, and it's not a cliff. So we fully anticipate that projects will continue to move through this throughout the different burn down phases of the abatement. But Brian's right. If you want the absolute most abatement, which why would you not want it? You are incentivized. I mean, why we did this is that the market was in a bit of a malaise. Like we had to make a catalyst for action. So the catalyst for action is creating a window that is defined and time bound, where if you don't have your Alt-1 permit by June of 2026, then it's not that you won't get the abatement, you just get a slightly tiered down abatement. So yes, start your projects now, but I also think, it's important to relay to the investment community because, investors are looking for opportunities to do today, but then also a repeatable business model. There will be ample opportunity to do follow-on conversions in, 3 years, 4 years, 5 years from now. My view.
What Ryan's trying to say is, can you extend it?
Maybe the next administration will take that up.
ICAP residential, correct?
An ICAP for residential? What do you mean by that?
Industrial, they have industrial commercial abatement program. And the improvements are exempted from taxation for about 18 to 20 years.
Yes, yes, it's a form of a tax abatement program, but it's structured very differently than ICAP. But yes, it would be the residential version of ICAP.
But with an affordable housing
requirement,
or permanent affordable housing requirement.
25%. So we're coming up on the hour, but this is a panel that has spoken in several combinations, and they're a professional panel. And I know that with all the questions that I prepared, there's a question that I haven't asked that they may want to speak about. So I'll throw that out. Melissa, if you want to go first and we can go down, put you on the spot. Is there something that we didn't cover that you want people to know?
Well, we haven't touched on the Midtown rezoning. I think you sort of teased that, Ken, and others have alluded to it. Not only did New York City pass the City of Yes for Housing Opportunity in 2024, but there are 5 neighborhood-wide rezonings that this administration has committed to see through by the end of this year. One of those has already passed. It's the Metro North Bronx. There's another one that's in central Brooklyn. There's Long Island City, there's Jamaica, and there's Midtown South. So Midtown South just came out of the block last week with a lot of announcements on really getting the environmental review underway for that. But the sort of shorthand history is that we're talking about the garment district within New York City. So many will sort of know this area. 7th Avenue, 8th Avenue, just below 42nd Street. I don't have all the specific geographies because it's a bit block by block, but it's a phenomenal opportunity in an area that actually is mostly prohibited for housing. This zoning will enable housing to occur. In addition, because of the 12 FAR cap being lifted, and because the Garment District is somewhat low rise, and it's not low rise, but it's, you know, it's not as tall as many of the other commercial districts within New York. There will also be some pieces of it will enable a substantial upzoning as well. So I think that's tremendously exciting because this is a very well-connected part of the city. I mean, incredible transit links. So many subway lines are already running through this area. This project is going through, this neighborhood rezoning is going through environmental review. It's expected to enable 10,000 units of housing to get created, as well as some conversion, though I would say when I look at the balance in that program between what is a likely conversion and what's a likely tear down new construction, I would say more of the value creation opportunity is going to be through the new construction, just because you'll be able to build so much higher.
So John has sent me a few questions. I think we've covered some of this. I'd like to go on with the panel, just continuing. Yeah.
Oh.
Okay, thanks.
I don't know that there's anything really that we didn't cover. I guess just on the topic, we did talk about, you know, alternate uses. It isn't all just going to be converted to residential, but I do think there are other sort of potential opportunities, you know, uses, and you mentioned education. You know, we've been actually recently been asked to look at some of these from a senior living standpoint. So different type of housing, you know, could the, you know, the rooms, the units be at the end, and then maybe the interior part of the floor plate for the more clinical supportive uses for that type of population, which we think is interesting. So we're seeing a little bit of momentum there. But I think there's, you know, we got to get creative with this aging stock, right? And I think, you know, especially being in the Northeast, you know, New York, Boston, these mature, physically mature cities, that we're tearing down and building new just doesn't make sense in a lot of, you know, we've got to collectively as an industry get creative about how to reuse these. So we're kind of excited about this, but think that there's also more potential.
Thank you, Daniel.
First off, you know, thanks so much for having me here. It's been a pleasure speaking with everyone. I think we covered a lot of topics here. I guess my only ask would be, please, could we extend that 467M a little bit further, because, you know, we'd like to do a lot more projects.
I'll leave it off with this. So I would, if you haven't been to a building that's been converted from office to residential, I would highly recommend you tour it. And I think you would be hard pressed to see the difference in quality between a brand new residential building and an office residential conversion product. I think that there will obviously be differences building to building. Like if you're in a 50-story building with just glass curtain wall, it'll look very different than a building that was converted from like a cast iron loft that has a brick fenestration and giant, you know, giant casement windows. But the quality of that product will be, I think, on par. And that is why when you look at the rental rates for new build and conversion, you're really seeing very little discrepancy between the two of them. And if you haven't had an opportunity to tour, I would highly recommend you do that.
How does the 25% affordable component impact that pro forma?
I think that it's a very complicated question.
Sorry.
Since we're almost out of time. Look, I think the city and the state in partnership with industry did a really good job of understanding how to make the incentive program make financial sense from a developer perspective, and yet also deliver the affordable housing that the city needs. And the affordable housing that's being delivered is a lot of different income bands. So it's not just like really low income housing, but it's actually affordable housing for working people probably that are in your office. And they can actually apply to this program and actually afford to live in Manhattan or one of the 5 boroughs. So it makes financial sense. And the one thing that I'd say to all elected officials, and Melissa knows this as well, is that it's a binary outcome for these programs. Like you're either going to do it or you're not. It's not like you're going to do part of it or a little bit of it or whatever. So it has to be financially, economically beneficial to the developer to opt into these programs, or else they won't. And I think they did a really good job of finding that balance to make it beneficial and yet deliver what the city really needs.
Can I add one more thing? Sure. I know we're just out of time, but we're talking about the tours, that's a huge, one really positive thing to me, when you first do these and you talk about the learning curve, when I first started doing these, I was so trained in like the perfectly proportioned units in ground up and designed via spreadsheet, everything was hyper efficient. There's inherently some inefficiencies when you're dealing with these existing buildings. We're trying to get as many units in as we can in there, there's some unusual layouts, at least looking at them on paper. So like, again, when we finish 160 Water, I would not show people the floor plan. I would tour them through and then show them the floor plan. Because when you first look at it, you say, wait a minute, what is this unit that snakes around to get to the corner of the building? But actually the market has reacted really positively. These are unique. They don't feel cookie cutter. They feel like it's high quality. There's extra closet space in the back. There's these kind of unique nooks and crannies. You have to kind of embrace that. And sort of be okay with it, because we're just so, especially I find the developers who have done a ton of ground up resi have the hardest time getting their head around this, because they're so programmed on this is how we do it and there's no other way. So I think, you just made me think of that when you talked about touring these projects. That's been like the biggest thing for us, is to get developers who have never done it, walk them through, make them understand it.
Thank you. That's fantastic, because in this little ending session, we've addressed all of the questions that have come in organically, which is the best way. Thank you to our panel, to Melissa and to Robert and to Dan and to Brian. It's been a pleasure.
And you forgot to end with, we'd like a tour.
Oh, sure. We'll set that up after.
Inviting us all.
After the conference.
I mean, yeah, Denim, my project is opening hopefully in the next week or so. Down at, the address of the building is 25 Water Street. It used to be called 4 New York Plaza. And it's actually been rebranded Soma. So if you have a chance, take a look, and you're welcome to come down and reach out to Ken and SIOR, and we'll be happy to arrange it if you'd like to come.
Thank you. Thank you very much. Okay, the next panel will start in approximately 10 minutes.
Ladies and gentlemen, for our final session, we're going to have a quick little ceremony. Sadia Sheikh is actually going to pin Bob, not a fraternity pin, but Bob is our newest member of the New York City chapter. We couldn't be more proud of this. And Bob had once said, "Where is my pin?" at the holiday party. So now we have a pin. So please.
That's great. I'm thrilled. I was noticing the pins. I'm like, hey, you know what? I have to get one of those. And there we go.
See, here we go. So this is our final session of the day. It's time for, and I coined this term last year when Bob was at our programming last year, the transactionist. But now we're adding the closer. So this is Bob Knackel, the transactionist closer. Since I know you like the Yankees in sports, I thought we'd start with this. This is a little statement from Anthony Edwards when playing Shai Gilgeous-Alexander the other day. And he basically said, he's consistent every night. His team is going to give him the ball and just let him rock out every night. It's nothing to think about. Hey, get Shai the ball, and he's going to get busy. And then we're going to figure out after that. I love watching that. It's incredible, man. If he is keeping him like that, I hope they're the MVP to him for this year for sure. I feel like he should have won it last year, but he's playing out of his mind right now. No offense to you guys in the media, but the best satisfaction is when your peers and the guys that do the same thing for a living at a very high level that you do recognize and respect your craft and your talent, Gilgeous-Alexander said. That's a really good feeling. Obviously, the caliber of player he is, the sky's the limit. Let me repeat, but the best satisfaction is when your peers and the guys that do the same thing for a living at a very high level, that you do recognize and respect your craft and your talent. And that's Bob. So it's an absolute honor to have him here again. And now I'll go through some of his accolades. Also known as BK, has been a broker in New York City since 1984. Oh, wait a minute. Oh, wait. Save some of the best here. Uh-oh. Nope, we're going backwards, I believe, because this thing's upside down. There we go. Now we're talking. And if anyone had baseball cards back in the day, that's a 1974, I believe, vintage.
72.
72. Yeah, it's fantastic when I saw that. So we were talking about humility before. Bob did not want that up there. Bob did not ask for that to be up there. I found it on his website and then approved it through his people, and we got it up there. But I thought this was apropos. So over that time period, since 1984, he has brokered the sale of 2,341 buildings, having a market 42. Is that for us? Thank you, for us. 42 of approximately, is it 22 billion? Are we still correct? All right, thank you. For 26 of those years, from 1988 to 2014, he owned and ran Massey Knackle Realty Services, which sold more than 3 times the number of properties as the #2 firm in New York City from 2001 to 14. Running the firm with a servant leadership management style. So we're going to get back to that because I thought that was fascinating. Focusing on empowering everyone on the team, intensely training them, and building their self-esteem led to this overwhelmingly dominant platform. The firm was sold to Cushman & Wakefield in 2014 for $100 million. Massey Knackle legacy is illustrated by the fact today in New York City investment sales market, there are 30 companies or divisions of companies that are either owned or run by folks who learn the business at Massey Knackle. Bob is prominent as a prominent thought leader in the commercial real estate business, frequently writing about the market, lecturing on the market, and appearing on podcasts and national television shows on networks like Fox, CNBC, and MSNBC. Most importantly, some basic math. Let's see, 82,572,504 rentable square feet has been sold. The Empire State Building is 2.8 million feet, or Bob has sold basically, Faraz? 29.5. 29.5 Empire State Buildings. I just want to sell one. A lot has changed in 1 year since we last conferenced. Last year, you were JLL. Now it's BKREA. Tell us about BKREA and how it's expectedly taking over the investment sales market.
Yeah, well, John, thanks for that introduction. I wish my folks were around to hear that. That was great.
Oh, by the way, it's recorded
Okay.
and live streamed. So we have a recording. If
Right.
you
Well, hello, everybody out there. Thank you for having me today. It's a pleasure to be here. And the way I'll sum up what we're trying to do at BKREA, and so happy to have so many of my colleagues from BKREA here today, Faraz in the back, and Genesee and Jazz, and I think Ryan maybe, or Ryan had a tour, but you know, I think I've always tried to do things a little bit differently. And so when we formed Massey Knackle back in '88, we created the business based on a geographic territory model, where we put one broker in a neighborhood and had them get to know everything about that neighborhood. And that was very, very unusual for the commercial business back in those days. In fact, it really wasn't anything that we dreamed up. We weren't innovative in coming up with that. That really is a residential broker's approach to the market. I mean, a broker in the suburbs rings a doorbell and then goes to the next house and rings the doorbell and goes to the next house and rings the doorbell. That's exactly what we did. We just applied this residential farming approach to the commercial property business. And the reason it worked back then is because publicly available information was very, very sparse. And what was available was very inaccurate. So we said, hey, look, if we get to know every building on every block and every block in this neighborhood, we'll know more about this neighborhood than anybody else. And we're not really in the real estate business. We're in the information and relationship business. So let's have better information than anybody else. And it worked really great. I remember we did a pitch, early on, and the owner said to us, well, you guys have only been around a short period of time. You've only sold a few buildings. I'm talking to people who have been around for 20 years. Why should I hire you? I said, yeah, those people have been around for 20 years, but they're selling stuff all over the place. We've only sold 3 buildings, but one was down the block, one was across the street, and one was right next door to you. We know more about this neighborhood than anybody, and we can be a better advocate for you in terms of convincing people why they should pay more for your building. And it started to really snowball. It got great traction. And so, you know, we looked at the business a little differently and did brokerage with that information-based approach. And back then it worked really well. So how are we trying to be different today? Well, how we're trying to be different today is doing brokerage, not like a broker, but doing brokerage like a developer would. Now, what do I mean by that? Well, there has been very, very profound changes in the real estate business in New York based on legislation. And we have new zoning changes. We have City of Yes, we have 485X, a lot of the things the panel spoke about before with 485X and 467M and UAP and all these different things. So in a lot of ways, I feel like I'm starting from scratch and everybody in the market is starting from scratch. I'm just fortunate I have a 40-year track record behind me. And so what we've done is we've said, if we want to really understand all this new legislation and be able to use that understanding to advantage our clients and get better results for our clients, we really have to know everything about it, the ins and outs of it. So what did we do? Number one, I realized that that technology was changing very, very profoundly. And if you look at me going back to 1984, sitting at my desk, I had no cell phone, no fax machine, no computer on my desk. We carried rolls of quarters around in our pocket so we can go to the corner and make a call from the payphone. And you look over the past 40 years how things have changed. I think the extent to which the world is going to change over the next 5 years is going to blow away what's happened over the last 40.
I'm gonna change the experience for everybody, like
Push the button.
on your microphone. Technology.
There we go, technology, there we go, okay.
We didn't have to
So-
wait the 5 years.
That's it. So knowing that technology was going to change so much, first hire for my new firm was an AI guy. I hired a guy who started AI companies. He worked in driverless cars for 6 years. I figured, hey, if you can make a car drive itself, you can help me sell a building. So that was step one. Step two was hiring a bunch of folks who could help interpret, understand, and figure out the ways to maximize all this new legislation that was going on. So we hired a zoning attorney and an architect and a data scientist and cost estimators and people who, you know, you talk about converting an office building to residential or some other use. We can do that in 48 hours. We can figure out whether you can do it, how you can do it, what you have to do to the building, what the layouts can be. With zoning, for instance, we just won an assignment on West 44th Street for the Durst family. They interviewed 4 brokerage companies. The other 3 companies said, yeah, we think it's worth X dollars a foot and you have 60,000 buildable feet here. We went into the pitch and said, you have 74,000 buildable feet here. And they said, how can that be? Everybody says it's 60. It said, you read the docs, it's 60. I said, yeah, but in City of Yes, there's something called what is the recess called? An accommodative recess. And rather than sky plane exposures, which is under the old zoning, this accommodating recess creates like a curved arc of angles to increase the size of your envelope, and you can fit more air rights into it. And so we were pitching a 74,000 foot site. Everybody else was pitching a 60,000 foot site. We got the assignment. So this is a way to take advantage. So what's BKREA? BKREA is a company that has its roots in old school analog stuff. I love paper. I write stuff down. If you follow me on social media, you know I have my map room, which has a map. These right Tom's writing stuff down. The map room has a Sanborn map that's 24 feet long and 10 feet wide that identifies every single property under construction that's been demolished, potential development sites, assemblage sites, highlighted in different colors. And it's about as paperish as you can get, but we have everything backed up with stuff digitally, and we're using all the AI models and all that kind of stuff. So it's very much an analog business that uses AI in ways to create extra supercharging of what our analog stuff is. And we're trying to think like developers, not think like brokers. So that's what the new company is, trying to do things a little bit differently.
It's exactly what I wanted. I mean, I wanted all the brokerages and SIORs, and we're supposed to be the best of the best to learn something new. And that's why we throw these conferences. So that was fantastic. 2,321 or 22 closed transactions. We need an update on what's in the pipeline. Since I saw you a year ago at our conference, and then you left JLL and you formed BKREA and went out, what's in the pipeline?
Right. Well,
I've heard a staggering number,
Yeah,
so I want to confirm this.
Okay, we started the company April 2nd. Since then, we've closed 2 transactions, a $24 million office to storage conversion, a $27 million office to resi conversion. Have 2 development sites under contract, a 118,000 foot site on West 37th Street, a 120,000 foot site on 71st and 2nd. That one's closing next week. And we have 31 exclusive listings for $2.2 billion.
$2.2 billion. I thought that was worth repeating. So fantastic. And yeah, another reason I wanted Bob here today was to explain some of this for the brokers around the country and locally. Can you explain the servant leadership management style? I said we'd get back to it.
Sure. Well, I think it's interesting that, the servant leadership management style was created by and developed in the 1970s by a guy named Robert Greenleaf. And Greenleaf's theory said, when you serve people, when you lead people, you lead them best by serving them and wanting them to have every advantage that you have, that you want them to do better than you do. And everyone gives lip service to this. And I've seen it everywhere I've been, every time I've gotten to look under the hood at different companies, everybody preaches it, but very, very few people actually do it. Paul and I actually did it. And what it was based on was a number of very fundamental things. One of them is training people. And so we had very intensive training. We had initial success training. If you came to work at Massey Knakal as a broker, you were not allowed to get on the phone and talk to a client until you passed initial success training. What did that mean? You had to do a 3-year comparable sales study in your territory and know every building. You had to know who owned the most buildings, who owned the most square footage, who owned the most units. You had to go out and walk the streets, take pictures of every building. Back in those days, we had no Google Maps or Google Earth in those days. You had to go out and actually walk around and take pictures of the buildings. And then you had to study how to put the broker's opinion of value together and how to give the marketing pitch. And you had to pitch a panel of senior people at the company and pass that pitch in order to be able to get on the phone. And then we had continued success training where every week we had a session that was run by one of the senior people in our business, or we had guest speakers come in. We had, for instance, Bob Cialdini, who was the head of the psych department at the University of Arizona, probably the leading authority in the country on persuasion. We had Tom Donaldson, one of my Wharton School professors, to come in and talk about business ethics. We had Bill Urey, a Harvard professor who wrote an unbelievable book called The Power of a Positive No, come in and talk to us. What does that training do? Well, number one, it helps people develop skills and become aware of things they should be doing. But it also sends a very powerful message that the company cared about them and wanted them to succeed. And you had to build up their self-esteem. You have somebody who feels good about themselves going out and performing, they're going to perform a hell of a lot better than if they don't feel good about themselves or they don't think the company cares about them. And what I mean by that, and we did this clearly, our top producers, we wanted them to feel good and to go out and kick butt and do a great job. But the guy who ran our mailroom and stuffed mail, back in the old days before email became popular, we were sending out 3 million pieces of hard mail a year. We were blanketing the market. And, you know, when we did these bulk mailings, if the guy who ran our mailroom could, you know, put a rubber band around 100 pieces that were all going to the same zip code, we saved like 3 cents a piece. And it sounds like a little thing, but this guy took such pride in what he did. And, you know, we'd say, hey, Harold, you know what? You're doing such a fantastic job. We notice everything you're doing. We appreciate, you're really doing an unbelievable job for the firm. And let me tell you something, that guy, when he had a stack of envelopes, the corners were perfect. I mean, everything he did was great. We talked to our receptionist and we said to the receptionist, you know, you always greet everybody with a smile. They walk in here. This is the first impression they get of our company. Thank you for doing such a great job. And for the next 2 months, somebody would walk through that front door. It was like their long lost aunt or uncle walked into the office. They were treated so well. And so this created a culture that is something I was very, very proud of. Like you said, John, we have now 31 companies or divisions of companies in the New York City capital markets world that are owned by or run by people that learn the business at Massey Knakal. And that, of all things, yeah, we sold 3x the number of properties as the number 2 firm. Very proud of that. We sold for a big number. Very proud of that. But the thing I'm most proud of is that I think we very fundamentally changed the lives of the people that we worked with. And that's evidenced in those 31 companies. And, you know, now something I want to fundamentally change the lives of the people working with me now. And so, you know, yeah. To me, that's servant leadership.
True nature of a giver, and purely the true nature of a giver. Treating people right and then supplying them with the information to succeed. It's a fantastic combo. How is your office internally structured?
Yeah, we have a bullpen. Always a big fan of Mike Bloomberg. And, you know, he famously sat right in the middle of the bullpen. Genesee, where do I sit? That's right. I've been doing this 41 years now. In my 41st year, I sat in an office for 3 years at JLL. When JLL bought HFF, they bought it on the proviso that the HFF guys run everything. And the HFF culture was very office centric. And so we were legacy. We'd been at JLL about a year. And the HFF guys who were running the office came to me and said, hey, BK, we need you to go into an office. So I was sitting out in the middle of the bullpen. And I said, I don't want to go into an office. And then, no, because we're all in offices. If you guys are all in bullpen, it's going to look bad. You have to go in. Please go into an office. I got to tell you, it was the worst 3 years of my career. I hated being in there. And I got so used to it. It was so strange. Like, I actually got so used to the quietness of the office that I would shut my door when I'd be on Zooms because I wanted absolute quiet. And I was like, wow, this is really strange. Like a little ambient noise out of the office was bothering me. And then, you know, of course, I get fired by JLL and I have my map room set up. Map room is about a 600 square foot room. And I had a couple of folks working in there all the time, and just out of necessity, I'm working from there. You have people around now. I'm totally used to all the noise going on. I'm doing Zooms and podcasts from in my cube in the middle of the floor. And I think that works great for a couple of reasons. One, I want to hear what everybody is saying, what they're doing. You know, I don't like it to be quiet in the office. I want everybody to be on the phone when you're in the office. And then importantly, I want everybody to hear what I say. I often put my phone on speakerphone. Everybody, if you're sitting around, you can listen in on my conversation, hear how I address people, how I talk to them, how I overcome things that they say. And I think that is a great learning experience as well.
The investment sales market today, driven by a couple of factors, the office to resi conversions we've heard about, the inability to refinance. You mentioned some development, the city of yes. What do you see as the major contributing factors right now to the New York City marketplace?
Yeah, well, I think it was interesting. I was on CNBC with Brian Sullivan back in early February of last year. One of the things that led to my firing. But I was on with Brian, and I said, you know, Brian, 2025, we're going to have the biggest sell-off in the history of New York City. He said, really? Why? And we got into it. And a lot of people after that, I got a lot of DMs and texts and emails saying, Bob, you're out of your mind. What are you talking about? And if you actually looked at the volume of sales in the first quarter of last year, It was completely flat with 2023. But by the end of the second quarter, it was up 40%, end of the third quarter up about 62%, end of the third quarter, it was up, end of the second quarter up 40, end of the third quarter up 62, ended up, we don't have the final numbers yet, but it's going to be up in the somewhere between 82 and 85%. But in 2025, I think we're going to have the highest turnover we've ever seen. And to give you a sense of what that looks like, in Manhattan, south of 96th Street, there's 27,649 buildings. The average turnover of that stock of buildings over 40 years has been 2.6%. And remarkably, it was 2.6% at the end of the 80s, at the end of the 90s, at the end of the noughts, and at the end of last decade. So the volume of sales reverts to the mean all the time. And we're now going on 7 years where the volume of sales has been below the mean, which means there's a lot of pent-up demand to sell in the market. And one of the things that's unique about this downturn, I'll say this is the 5th downturn I've been through. S&L crisis, early 2000s, GFC, what I call the Great Slog, which was from October of 15 through April of 21. We had a 12-year hiatus from this correction, which was second half of 21, first half of 22. March of 22, Fed starts raising interest rates, exerts downward pressure on prices. We're now in what we're in. And the different thing about what we're going through right now is that in the past 4 big corrections, you've had every property type losing value, just to different degrees. Today, different sectors are performing differently. I would argue today the retail sector in New York is very strong. It was negatively impacted years before other sectors were, but retail is good. The hotel market is absolutely on fire. The land market is coming back. So we have sectors that are doing well, but then on the other side of the coin, we have multifamily, which has been devastated by public policy. HSTPA, which is rent laws changing in June of 2019, absolutely crushed the market. And I mean, I could talk about housing for hours and hours, but the multifamily business is very, very challenged right now because a lot of folks have debt that's at 3 and 3.5%. And if you're refining today, it's 25 or 35% cash in, and your interest rate is going to double. So you're going to put 25 or 35% fresh capital in to refinance, and your mortgage payment's going up. That's not a good deal for a lot of people. They don't want to do it. So if you have the cash, you're in a dilemma whether to put the cash in or not. If you don't have the cash, the writing's on the wall. And the B and C office sector here, very, very challenged. And that's why I hired Faraz to run our office to resi conversion business, because what's going to happen with B and C office, and you need to disaggregate B and C office from Class A new construction, which is doing really, really well. But B and C office is going to be broken down into 3 buckets. There will be a sector of it that will be upgraded and stay office because every tenant can't pay $200 a foot in a new building. There will be a bucket that'll be converted to residential because there's a lot of incentives to convert buildings to residential. The 467M tax abatement is one of the most powerful things the city has done since 1961. You're going to see that help a lot of conversions. And then there's going to be another bucket that's just going to be demolished, because what happened was the city came out with this tax abatement program that was a successor to 421A in the old days, which was then modified to become Affordable New York, and now it's called 485X, and it's the biggest, most useless piece of legislation that's ever been implemented. You have some buildings under 99 units that'll be built. Very, very unusual to see anything that's going to be built over 99 units. I think our policymakers have complete egg on their face about this being such a clunker. And so now the next big rezoning initiative is the Midtown South rezoning. And I think realizing that 485X was such a dud, they didn't want to have another dud right after that. So Midtown South rezoning was going to take the floor area ratios, which tells you for every square foot of land you have, how many square feet of building you can build. They were going to take them from 10 to 12. They've taken them from 10 to 18. So because of that, I think you're going to have half the buildings in the Garment Center are going to be demolished in the next 10 years. So what's happened is you go to 40,000 feet again, you have You have sellers who have pent-up demand to sell in sectors that are doing well: retail, land, hotel, industrial. And then you have that those will be discretionary sellers in 2025. But then in the multifamily space and the B and C office space, you have non-discretionary sellers who have no choice, have to sell. We've never had these two groups of sellers behaving robustly at the same time. Normally in a bad market, non-discretionary sellers have to sell, discretionary sellers don't, and it's the opposite in a good market. So I think if you look historically at this turnover, I said 2.6 was the average turnover. Generally in downturns, volume has hit 1.6% at a low, although in 2009 it got down to 1.2%. The highest turnover we ever saw was 4.3% in 2012, as a number of sellers were rushing to beat the 3.8% capital gains tax increase that was embedded in healthcare. I think we're going to see turnover over 5% this year. I think it'll be the highest we've ever seen for the factors that I mentioned.
Have you just noticed a couple of brokers left and are going to make calls? Now, just some general stuff. In your history and from your past, what have you drawn upon, or what's a motivator, or someone or something that you looked up to that made you who you are today and as successful?
No, I think, one of the things that drives me is from the time I was a little kid, I've always been very, very competitive. And, real estate is a very competitive business. We always liked hiring people who showed excellence in a competitive environment. Team sports was great for that. But, maybe you were the president of the class of your class, or head of the debating team, or publisher of the school newspaper, or something where you showed excellence in a competitive environment. And I think competition is great. Look, I'll be the first one to say, look, JLL firing me was a great thing for me, because it got me out of a contract I wouldn't have been able to get out of. But who likes to be told that they're not wanted? So I've got a giant chip on my shoulder. So I think a big component of why we have 2.2 billion in listings right now is because I feel like I got to show the world. And it's that competitive spirit that says, hey, you know what? I want to go out and do it. And I think that's a big part of success in this business, just feeling like, you really want to go out and kick some butt.
Go for it.
I was going to ask how much you like JLL.
No, and then let me be the first to say also that there are pros and cons of every environment, of big companies, small companies, medium-sized companies, working for yourself, working for someone else. I always tell people the key is try to take as much benefit of the positives as you can, try to keep your head down from the negatives, and just do the best you can. But pros and cons to every environment.
So from Frankfurt, Germany, we have a question. On your projections, where and when is 3,000 going to happen?
Oh gosh,
that's impressive from Germany.
Yeah, that is impressive, because it has a lot to do with baseball. As you can see, the baseball motif. But I actually played baseball as a kid. I played baseball in college, and so I was one of the kids who I collected baseball cards as a kid. But I always spent more time looking at the back of the card than the front of the card, because I love the stats. I figured probably another 10 to 15 years.
Awesome.
But people say, hey, BK, why are you still doing this? Why don't you retire? Well, one, it's the competitiveness that I enjoy about the business. But I mean, let's face it, I talk for a living. I'm not like, breaking rocks. So as long as I can still talk, I want to keep doing it. It's fun. I get to talk to interesting people. And so no plans to retire.
And last question I have is something that's in your office that's meaningful, something on your desk, or something that, just really speaks to you, who you are, some accolade or some accomplishment.
Okay, well, I'll mention first time I heard this question was before we got up here. John gave me a couple of days. You mind if I ask you this? And I'll tell you that, I've been thinking about it, and there's 4 things I'll share with you that are meaningful to me. Number one, the lucky penny. So Paul and I are selling our first building, 1421 3rd Avenue. It's 20,000 foot vacant furniture showroom on 3rd Avenue and 84th Street. And, we were kids. We didn't know what the hell we were doing. And the closing took place at this very small law office wasn't enough room for us in the conference room, so we're sitting in the reception area. And we hear of the seller was this really, really very loud woman, Mrs. Almendaris. And several times you heard her screaming in the room. And at one point, she comes running out of the room. I'm not closing. You can't have my building. You can't have my building. And she's going, her attorneys are grabbing her, come back into the room. And Paul and I looking at each other like, what the heck? Is this the real estate business? So I had a penny and I'm just flipping it. And it must have gotten on Paul's nerves. He said, Bob, what the hell are you doing? Put that down. And I, put it down for a second. Then I'm flipping it again. It's just kind of a nervous habit. And fortunately, the deal closed. So we're walking back to the office and we get, we walked back 12 blocks. And I think my feet didn't even touch the ground. But we closed the deal and reached into my pocket. Hey, the lucky penny. And that penny I taped to my desk. And it's been on every desk I've ever had. It's taped to my desk at BKREA now. So that's number one. Second thing was a picture of George Washington on a horse. My maternal grandfather was quite a patriot, loved the country very, very much. And he was an assistant plumber when he was a kid. And when he was in his 30s, he started his own plumbing shop. And as a gift, the day he opened the plumbing shop, my grandmother gave him this framed picture of George Washington to put on the wall. So 1988, we opened Massey Naco. 1988, we'll open the company. My two aunts show up at the front door with the picture of George. So George has been hanging in the office all the time. And then two of the things I have in my home office from my other grandfather all four of my grandparents grew up in Prague, were born in Prague, came over from Czechoslovakia. And the one thing my grandfather bought was a little toy house that was a Christmas ornament. And just took it off the Christmas tree this past weekend. Sits in one of those Bluesite baseball holders, but that's there. And then the other thing is this little stuffed teddy bear that my father kept in his car all the time for some reason. I guess if I was acting up in the car when I was really little, gave me this little teddy bear to play with, and it has one of these mini Chicago Bear helmets on it. And so that thing has been behind my home desk all the time. So those are four things that are very meaningful to me, that are with me whenever I'm working, whether it's at home or at the office.
Fantastic. Any questions? We have some. Yes?
Me?
You finally get to go. I know you've been waiting all day.
Work in a rough and tumble third-tier market, and your friend Rod was so nice to introduce me to you and my dual designee, Faraz, in the back. And I read in the paper about you going out 285 nights a year. I heard you got fired. I found the article in the New York Times, and my wife looked at it, who runs my shop, third wife for 30 years. And she said to me, "You're Bob Nacco, for going out that much, but your motivation for me is, and your friend Rod and your friend Faraz, you guys do LinkedIn, you share, and I want to just thank you very much."
Yeah, thanks, Tom. Appreciate it. Thank you.
Is there anyone else? Mary?
Just curious, Bob, you obviously do investment sales, you sell buildings to investors. What about the leasing of these buildings and your team? Did you try to avoid that? Have you never done that? Like, tenant representation, all that stuff. There's a bucket of money there. It wasn't your thing. You did what you did well. Can you speak about that?
Sure. You mentioned lease. What's a lease? No, I'm a very big believer in the fact that as brokers, you have two main assets: your knowledge and your time. We're all trying to increase our knowledge base every day, but you can't get more time. So I think the more highly specialized you are, the more time you create for yourself and the more horsepower you give the time that you spend. And as an example, so let's say last week I sold 3 buildings, a retail property, an apartment building, and an office building. And this week I'm pitching an office building. That office owner couldn't care less about the retail property of the apartment building I sold. Wants to hear everything about the office building I sold. Had I sold 3 office buildings last week, then this week's prospect is going to want to hear about everything I did last week. That's the way you multiply your time and get more time, by using your time more efficiently. So I think, you know, I often have over the years that people come say, hey, BK, you know, this guy wants to rent this store. Can I rent the store? This person wants to hire me to rent their apartments. I can make money doing this. And I'm like, yeah, you can, but you could go to the corner, sell cocaine. You can make money doing that too. Is that what you want to do? Like, do what you do and make everything that you do accretive. I equate what we do to, like, every deal you make, every relationship you make is like creating a cinder block, and you're building a foundation of a home. If you're doing all kinds of different things, you're putting a cinder block over here, one over there, one over there. And after several years, you have partially built foundations all over the place, but you can't live anywhere. If you just do one thing, you have a beautiful foundation, beautiful house on it. Say, make what you do accretive towards getting the next one. So I think specializing and not trying to get, and it's a lot easier to do in very big, dense markets. I have this conversation a lot of times with people, particularly in tertiary markets. It's very hard. You have to be a generalist. But to the extent you can be a specialist and just do one thing and do it really, really well, I think there are 3 things that I think enable brokers to get to the absolute top of the business. One is expertise. And I say, with that expertise, pick something that is narrow enough so that you absolutely can know every single thing about it. You are a true expert. It has to be big enough so that you can make a good living doing it, but make it as narrow as you possibly can. Second, passion. You have to love it. This is a hard business, and it's a cyclical business. And no matter how good you are, you're going to have tough times. It's the love of the business that keeps you around, that keeps you grinding, keeps you going, and then you'll be around for those good times that inevitably will come back. And the third thing is the ability to use discipline well. And I say use discipline as opposed to have discipline, because we all have discipline. We all choose to use it differently. But if you can use discipline well to do things over and over and over again, which is what it takes. You know, we always say you got to pound the rock. Pounding the rock is the stonecutter's creed, right? Stonecutter's creed, pound the rock. So stonecutter comes into the shop in the morning, sits in front of a big piece of stone and whacks that stone and hits it again. Hits it again, 99 blows. Nothing's happened. He's looking at the stone. What the heck is going on? Picks up the mallet, the 100th blow, boom, rock splits in half. To the casual observer, they say, oh, that 100th one, that was different somehow. That must have been a different mallet. Must have hit it harder. Must have been a different angle. But the stonecutter knows, no, the same exact blow. It's just the 99 that came before it allowed that 100th one to work. And in the same way, the things that we're doing with our market presence campaigns and everything we do as brokers, a lot of which is not very glamorous, but you got to make your calls, you got to send out your emails, send out your text, send out your hard mail, create your content, go to networking events, speak in public, be on social media, do all these things. Sometimes it's a grind, but you do it and do it and do it, and before you know it, the rock is splitting in half.
Nice. Steve.
Brian.
Oh, I'm sorry, Brian.
Chapter. I too, Bob, was fired from an interview with Brian Sullivan when he was at Bloomberg, a large firm. So
maybe Brian has some kind of a weird karma.
It was a very interesting interview. But thank you for sharing, and we're so happy that social media allows us for you to share your best practices. I noticed in all of my career, the broker opinion of value has been a very important document in my career, and I pride myself in educating and training my team to really formulate a good one. I noticed that's a very important tool. I'd like to hear if maybe some of the rest of the audience may not hear how that broker opinion of value, I'm learning on social media how it's very important to you as well in your company.
Yeah, well, you know, that's a double-edged sword.
Yes, it is.
And it is because, and I don't mean this in a negative way at all, but every owner thinks their property's worth 20 or 30% more than it is. And that's just human nature. That's not a fault. That's the way folks are. So it's a delicate balance between what actually is the value of the property, actually what you think the value is, and the game theory behind brokerage. And that is not science, that's art. And a lot of how you do that, you have, this is interesting, I've never spoken about this publicly, but it's a truth. A lot of it has to do with what position the seller's in, who the seller is, what their personality is like. I never like to go in and give a pitch to somebody I've never met before. So, you know, the first thing when somebody says, hey, I'm thinking about selling my building, first thing we do is say, hey, we want to come take a look at it. And I always try to get the seller himself to be there or herself to be there, because I want to meet them first and get a sense of who they are. It's tough to go in meeting someone for the first time and pitching them. But we try to let the market speak, right? Because if you, and this happens, this is a little after you get hired, but we talk about this all the time. If you're talking to an investor and they say, boy, that property is the biggest piece of junk I ever saw. We put in our marketing reports, Joe said, this is the biggest piece of junk I ever saw. The owner gets upset. Yeah, Joe, how could Joe have said that? Joe said it. It's in there. And so I think it's using information to try to have the client understand what the reality of the landscape is. And with BOVs, it's all about the market information. You have to have the market data to back it up. And that's why if you follow me on social media, you read what I write, I'm a huge proponent of proprietary information. I think, you know, if you're pulling a third-party report from an aggregator, a kid in 8th grade could pull the same report. So you're telling me you have 20 years of experience and you're pulling a report that an 8th grader could pick? You know, embellish that data with your own data, where you're in a better position. If you're a market participant, you're in a better position to get market data than anybody. So get that data. And that's another reason why I love development site sales so much, is because it's not as transparent as you would think. You know, generally the publicly available data on development sites is, hey, this was the site, this was the buildable footage, this was the price. Well, you have a numerator, a denominator, and you say, hey, it sold for this much a square foot. But were the bonuses in place? Were the bonuses under contract? Are there bonuses? Were there easements or rights of way you had to pay for? Were there options to buy other properties? Did you have to buy tenants out? I sold a $77 million development site at 77th and 2nd. The buyer had to pay $1.5 million for an easement through an adjacent property, had to pay $2 million for a light and air easement over an adjacent property, because when the air rights were acquired, the Zelda, which is the way you transfer air rights, wasn't done properly, and had to pay $10 million to buy out 2 rent stabilized tenants. Nobody else in the market knew that. So my numbers were very different from other brokers' numbers, but I knew those numbers because I did the deal. That's a competitive advantage. So with BOVs, I think you want to educate the client. You want to give as much market data as possible. That's why I say, you know, as a broker, the most frequently asked question you're going to get is, how's the market? Never answer it with adjectives. Anybody can answer. It's hot, it's cold, it's slow. What does that mean? If I tell you that the number of properties sold was up by 24% last quarter and the dollar volume of sales was up 32%, I will let the listener of that determine whether they think that's a good number, a bad number, whatever. That's a fact. You can't argue with that.
Any other questions? Sure.
Hey, Bob, before we leave from Syracuse, upstate New York, I was wondering if you could give some tips on time management. You speak about having discipline and using discipline. It takes a lot of time to collect data, do all the hard work that goes into this business. I was just wondering if you could speak to how you manage that over the years.
Yeah, well, I think time management is something that's probably different for everybody. But what I would say is I think that activities fall into a couple of different buckets. And I think your research is very, very important. Reading is important. Preparing is important. But there are two different things that we do, right? We work in our business every day, which is trying to do what we do to make money. But then we have to work on our business and take the time to work on your business. And that's figuring out what are the strategies and tactics that you're going to use. Are you going to go north? Are you going to go south? How are we going to, do things? And I think the working on your business part of real estate needs to be done on the weekend. You can't do that. I mean, generally, between 9 and 5, that's like a whirlwind. And you get so caught up in the whirlwind, it's very tough to be proactive. And you have to be proactive because if you've been in the business more than a couple of years, you could just react to things around you all day long. And when you're reacting, you're helping other people achieve their objectives. When you're being proactive, you're helping yourself achieve your objectives. So I think, to me, the most effective revenue generating activity is making prospecting calls. I don't call them cold calls because I've spoken to all these people for so many years. I call them prospecting calls. But if you don't proactively block time, 2 or 3 hours or two or 3 hour chunks of time, a couple of weeks in advance, you're not gonna get it done. And even like Genesee and I block out like 4 hours on Tuesday to make prospecting calls. How many times have we done it? Like you're always getting pulled, but you have to try to stick to that and block out several hours, at least 10 hours a week when you make prospecting calls. I try to work from home on Wednesdays and Fridays, mainly because then I can get my prospecting calls done. Because when I'm in the office, it's very, very tough because people are asking you questions, you're getting interrupted. In fact, before the pandemic, my goal every week was to speak to 50 property owners and get around to asking them if there's anything they wanted to sell. During the pandemic, I was routinely getting 100 connections a week. And it occurred to me, I don't know if any of you are Seinfeld fans out there, but the thing that made me less productive working from the office was the stop and chat. Somebody comes like, hey, how was your weekend? Before you know it, 8 minutes have gone by. So working from home, I actually was getting 100 connections a week. And I'm still, I would say 2023, I averaged 114 connections a week. Last year, I think it was I was probably in the 90s. So my productivity is falling up. But last year was very hectic with a lot of, the environment of the new office is requiring a lot of hands-on stuff. So I haven't been quite as productive on the phone, but still have as a goal to get 100 connections a week. But you have to time block out time, try to stick to it. Think about when you're most effective doing certain things. You got to work. Look, rightly or wrongly, it's a 7-day-a-week business. There's no time off in this business. And, I'm often asked about life-work balance. And what I'll say is, your first 10 years in this business, you have no work-life balance. It's all work if you really, really want to get ahead. And then after that, it's different for everybody. I can't give any of you advice on work-life balance because it's different for each of you. If you want to figure out what your right work-life balance is, do this exercise. This is unbelievable. Pretend you died. Pick 5 people that you want to eulogize you. Your husband or wife, a family member, a colleague from work, somebody from your church or synagogue, someone from your community, and write the eulogy that you want them to say about you. That's the blueprint for your life. That's the right work-life balance for you. And so if you want to work on your business and really be proactive and get ahead, you got to put time in on the weekends. It's just that simple.
One more quick one.
Nope.
All right.
Gutfeld, most popular talk show in New York. Do you think you'll go on there? I think you'd fit perfect, but maybe you don't want to give your opinions.
I love the show. I watch Gutfeld. You send him a note. I don't think I would have anything of interest to say on real estate. I don't know. I'll talk to anybody, anywhere, anytime about real estate, but about real estate.
Tom, you got your zinger in. I know you waited all day for that.
You're a good man too, John.
Thank you. Just concluding now, clearly Bob is a true giver. If you haven't read the NACL Nuggets, there are 44. Is it still 44?
We're up to 96.
Holy, wow. 96 to help anyone in the industry and in life. So yeah, get a hold of those NACL Nuggets. They're fantastic. And that's going to conclude this session. And as I end, I just want to say we're going to have another webinar soon coming up. We did global risk. There's so many aspects to global risk, so we might add to that with JS Held, but we'll see where we go with that. Mario, you're going to have an event in Long Island soon?
We're looking for the beginning of April, so it'll be hopefully sent out sometime next week.
Okay, great. The SIOR Spring Conference, May 6th to 9th. I asked for it to be on my birthday, Sadia. No go, no go. Thanks again to our sponsors for the event and for sponsoring our chapter annually. Special thanks to my SIOR team, Mario, Ken, Devon, where are you? Shocker, shocker. We can never find them. Sadia, for everything you do for all of us. And especially Caress, who couldn't be here today. She is our chapter director of operations. She handles all this minutia and helps me everything. She does just everything. She's fantastic. Mario, we're going to talk. We got to get her to Vegas. She needs to go. So our incredible speakers today, Shruti, as we all know, I mean, wow, lights out. Thomas too, Melissa, Roman Birch, Brian Steinwurzel, Dan Berman, and Robert Fuller. Fantastic. And then enough said. Do I need to say any more?
No, and John, just a special thanks to Sadia for giving me my pin today. Means a lot. Thank you so much.
Oh, that
Thanks
was
to
big. That was
SIOR.
big. And to conclude, we might have survived bombs, cyclones, turbo cancer, whatever else the media can throw at us, urban doom loops, and but can we survive 3 hours of open bar?